but also the retail investor as well, as they kind of hedge some of that equity and property risk that they're seeing.
Are global central banks hedging some of that risk, or are they just seeing inflation potentially coming back? I wonder whether that's the trade as well, because it's interesting. ETF outflows, but you've got central bank buying being a big feature of what is happening. Equity markets are expected to do, at a headline level, very little. We're basically waiting for the inflation data out of the United States. That's going to be the dominant factor as we work our way through the next few days. But let's see how we get on this morning. Keep an eye on what is happening with Currys this morning. Looks like Elliott is backing off that trade. That could be a factor that we're going to watch out for. In terms of other stocks, keep an eye on ASML too. Big sell-off in the chip sector in the United States Friday. Is that going to translate into the story here on Monday?
Right off the bat, you're seeing the FTSE 100 down about 0.3%, and it's just like kind of opening trades there. But you predicted it, the miners. They're the laggards this morning. You're seeing Rio Tinto, for example, one of your biggest weights, Glencore, as well off the back of that. You have some banking names in there as well. Barclays, HSBC underperforming. Even Lloyd's starting to weigh on the index more. Standard Chartered as well. But if you look at what's in the green, you're actually seeing some healthcare names and nothing really beyond that.
And to Guy's point on the semiconductors, because you saw NVIDIA, closing down about 5% on Friday. So the read across is there, pronounced in the technology sector, the second biggest loser after the miners. You're seeing BE Semiconductor, ASM, ASML. ASML currently down 2.5%, BE Semiconductor down 5.4%. So certainly the hit there. Infineon's in the mix, so is SD Micro in terms of the downside. So that read across is very clear in terms of the semi space here in Europe.
Feels like the market's looking for safety this morning. So Novo, the trade continues, but Nestle is tracking a little bit higher as well. You've got Sanofi, Novartis, AstraZeneca, GSK, all of those stocks are moving higher. ASML, SAP, Rio, Schneider. Beata Manthi over at Citi has got many of those in her Super 7 basket. She's also got Novo Nordisk in there as well, and Nestle, so maybe a little balance coming through as well. But some of the outperformers recently in Europe are seeing some weakness this morning, which again I think is reflective of that trade Friday out of the United States.
Yeah, the consumer names coming in hot as well this morning. Unilever, for example. Am I saying this right? Ocado. This is usually a name that you don't see in the green very often. And for example, for today it is, and it's not the only one. Like I said, there's a lot of consumer names up here next to healthcare, which
Who delivers your shopping?
Sorry?
Who delivers your shopping? Do you go to the supermarket? Does it get delivered?
I refuse to comment on the air.
Okay.
Wait, you have an army of minions. Delivering freshly baked baguettes.
Whole Foods around it,
When our production team goes home, they actually grocery shop for me. That's the situation I've got going on. But I didn't want to reveal that because now you're going to take my suppliers. Let's talk about something else.
Okay. We were just wondering about Ocado. That's grocery deliveries. That's why
Do you use Ocado?
Amongst others, there is a mix. Various vans turn up at various times, depending on pricing.
How much grocery delivery is a thing here, though. It's not.
I thought it was a thing in the States. I thought this was a massive kind of New York phenomenon.
I think they started out in New York, and then the concern is that you don't have they never picked the right product, so it actually kind of came for a second and then just disappeared.
So you're back in the supermarket?
I am back in the supermarket.
I like the guy diversifies his deliveries. Multiple vans at multiple times. I mean, he's not overly exposed to one delivery, which is smart.
Some companies are good at some things, some companies are good at other things. I'm not saying they all show up kind of consecutively, sort of one queuing up down the road after the other, but kind of month on month.
Do you do your own grocery shopping?
I want to talk about Currys. I'm surprised that people still go to Currys. Apparently they do. And so Elliott, or other retailers, Elliott pulling out of their bid. Yeah. Does that give JD.com then over in China more leverage as they look?
Massively.
They put in the bed.
Yeah.
Right. Yeah. So Currys would want to have those two competing bids. They drive up the price, but Elliott have pulled out. They say Currys hasn't properly engaged. Okay. And you've seen the stock down on the back of that. So the next move is what happens with JD.com, whether they revise their
management have made it very clear they think these bids are undervaluing the business. So I'd be interested to know why they think it's undervaluing the business. Again, we come back to this idea that the European stock market, UK stock market, very bad at valuing assets. Kind of where does this one shake out, and what does it tell us about how mispriced maybe London?
Don't worry, we've got the UK. We got the UK ISA now, guys. So that's going to fix everything.
Okay, yeah. I look forward to seeing exactly what impact that has. Tom says with a smirk on his face. I think we're still waiting. I think the bigger picture this morning is we are seeing a little bit of a wait-and-see strategy. You are seeing a sell-off coming through. Yeah. I think it's totally... This morning feels kind of very logical to me in terms of the market reaction. Miners are a little bit lower. You've got the iron ore trade. You've seen that in Australia already. Market's seen some of the sell-off we've seen Friday in some of the chip names. That's feeding back into the story here in Europe. That feels all very logical. And the kind of the flip side of that. But this comes back to this broadening story is where does the market broaden out from here? Are we going to continue to see this narrowness that we've seen, particularly represented by the kind of the Magnificent Seven broadening out? It's interesting to see the all cap, the equal weight S&P now tracking higher. You were bringing this up
back to levels of 2022. So the S&P equal weight index back to levels of 2022. So some would read that. So you've seen that broadening. Maybe that pushes back against the concern around the narrowness. But the PE ratios are actually around that 2015 average because the earnings are coming strong to match those expectations. Some relatively interesting moves in the bond market. So we're looking ahead to the UK wage data as well out tomorrow. It comes in before, of course, the US inflation print. A bit of money moving into UK gilts, 3 basis points. You're back below 4% on the UK 10-year. And you've been talking about the risks around a disconnect from the central banks. The Bank of England is expected by the markets to cut in August, to hold until August, while the ECB and the Fed go in June. So this is an interesting story in terms of the disconnect, arguably, amongst the big central banks. Does the UK remain an outlier because of the relative resilience of the economy and the stickiness of inflation?
Sterling's been doing very well recently. Yes. Massive outperformer. Inflation remains relatively sticky, but I think the surprise has come that the UK economy, it doesn't feel like it, has been relatively resilient. Maybe it's all the Ocado shopping that is happening. JP Morgan talking about the fact that they don't see the Magnificent Seven at peak valuations. They see much further to go. Yeah. So it'll be interesting to see how the market shakes out in terms of do you broaden out the market or does the Magnificent Seven kind of get another gear from here?
You know what I think is so fascinating here is that first off, JP Morgan isn't alone in that peak market pricing call, but stocks are actually, based on the metric you use, based on a lot of different metrics, PE, debt to sales, whatever you want to hit, actually less expensive right now relative to, more expensive right now relative to what they were in I want to say 2022 and 2023. And yet the calls for buying into it now are stronger than they were when they looked cheaper. That's what's confusing to me.
I think a lot of people are confused by this market right now. A lot of people are very confused as well. I just want to bring you a price on Currys. We'll put that up on the screen for you. As expected, the stock is under significant pressure this morning. Everybody's confused by the data as well. Certainly that was the theme coming out of Friday. The labour market data out of the United States, I think, posing as many questions as it delivered answers. You get a big headline number, you get a big revision, you get a big pickup in unemployment. What does that tell us about what is happening with the labour market? The acting Labour Secretary spoke to Bloomberg after the data was out.
The jobs numbers continue to be very strong. The 3-month average is actually 265,000. So, we look at trends as much as we look at monthly numbers. And our overtime figures demonstrate strong, steady, continued growth. Exactly what we want to see. It feels like the very definition of a soft landing.
The acting Labour Secretary, Judy Su, speaking to Bloomberg on Friday. That's last week. We need to talk about the rest of the week and what this week is going to look like, because it once again is going to be dominated by US data. It is going to be that CPI report, which I think is going to be largely the focus for a lot of people this week. We got that big surprise last month on the 13th. Are we about to see another surprise being delivered? it's really hard to call this time round, but I think you could see, like last time, potentially a big swing on the back of this data. There's a lot of other things happening, as you can see, throughout the week, but I think that's going to be probably the centre of attention. UK labour data, I think, could probably provide some interesting stuff to watch out for as well. Maria Michi, fund manager at M&G Investments, joins us now to talk us through the week. What are you watching? Well, good morning, by the way.
Good morning.
What do you think dominates this week? Is it that CPI print?
I think the CPI print is very much likely to set the tone for the rest of the week. There is some other very interesting data, including the US retail data, which I think will continue to provide more color to the picture of the US. But I think, yes, markets will be focused on US CPI, especially on the back of what we watched last week on labor market. And I think, to me, there were some very interesting developments last week that we have observed. First of all, I will point towards some of the revisions, which are very important for the payrolls number, and I think that it's important as a reminder that this data is, not always precise. So we have to be mindful about what the trend is, and sometimes, we get very focused on the actual data point and number, but the trend is really what we're looking at, I think, to try and understand how this can affect the economy.
Is the trend, to your mind, a trend that takes us towards central bank cuts in the summer? Is June on? Is that the most likely outcome? Are we priced for that? Would that be a surprise?
I think this is where the market is very much settled, and it feels now very much in alignment with what central banks are telling us. So there is less of a disconnect compared to what we saw, for example, at the beginning of the year. But the central banks do remain very data dependent. We've heard it last week from Madame Lagarde. We've heard it from Jerome Powell as well. There is very much a data dependency still determining what the next action will be. And this is why data is so important. But again, they're telling us they need a little bit more time to see how this data develop, what the trend is, rather than the single data point. And I think the other element, obviously, of the US labor market last week was the level of unemployment rising. And to me, one very interesting factor was how that was driven by people reapproaching the labor market, and in particular, women in the US. So I think that's a very interesting development as well, in terms of how the economy is moving.
What happened to Jay Powell's worries around easing financial conditions, asset price inflation? The last time we saw the stock market at these levels, Jay Powell continually was trying to drive the market lower. What happened to that?
I think there's been a very important shift last year from, the summer last year, where the message was very, very different and drove quite a lot of weakness in both equity and fixed income, all the way to the 31st of October. And then we had this massive reversal. The narrative has changed from central banks. There is more of a acceptance that, yes, rates will eventually come down, potentially this year, if we continue to in the same track in terms of data. And I think what has changed is the data that we're getting from an inflation standpoint, and not necessarily getting a faster pace in how this inflation is coming down, but the consistency of the data. So inflation continuing in this trajectory. And again, the US labor market data was supportive in that sense, because wage growth as well came at a relatively good level, consistent with potential cuts coming forward. And so they're getting more encouragement from data in this regard.
I find it stunning. Jay Powell talking about the idea that we're getting closer to cuts. He's sounding very positive. The cuts are coming. Yet we're data dependent. And the data's all over the place at the moment. How is he giving us this kind of forward guidance, setting the market up, and then potentially the data undermining that case completely?
But setting the market up for what exactly? And that's where I'm really confused. Sure, but what does that mean in terms of what the markets are pricing in? Because we keep talking about this volatility underneath, right? Fed swaps going from 7 to 6 cuts to now 3 to 4, and at one point it went down to 2, I think, at one point. And yet the nominal yields are not moving. And Maria, let's bring you back into the conversation. What do you do with bonds going into tomorrow's CPI data? The next 24, 48 hours, what does the bond market look like?
I think it's fair to expect that we might get a change in narrative from central banks again. And this is exactly because they remain data dependent. So they do give a level of forward guidance, but there is, they remain very much subject of what the market and the economy in particular is going to do on those two metrics. I think in terms of where we are for exposure to treasury market, but also more broadly other government bonds, there is an interesting analogy that was used by Madame Lagarde last week, week, which was around seasons and episodes. So I think, if we think a bit more longer term and we think about a more strategic asset allocation in the portfolios, there are opportunities today within sovereign bonds, really across the spectrum within US, UK and Europe. But we have to be open to more volatility as we continue to see that, as the market changes views on when exactly we are going to have, and if even at some point we are going to have this cut. So we have overall a positive exposure to sovereign bonds within the portfolios, but we remain open to be more tactical in terms of responding to volatility.
Is that at the long end of the Treasury curve? Where would your preference be if it was European sovereign versus US sovereign? And do you want to be at the front end, in the belly of the curve, or towards the long end?
I think the long end is where potentially there is more opportunity still from a diversification standpoint. So thinking about the longer term, the more strategic asset allocation perspective, the long end is where I will put more of the weight in the portfolio. But where we're playing more on a tactical basis, then this could be done also around fives as well, where we can play a little bit more on the volatility of the Treasury market.
In terms of fixed income more broadly, Tom brings up what's happening with Treasuries. What about credit? Spreads are super tight. High yield in particular, I know it's still kicking out a decent yield, but nevertheless, we have tightened and tightened and tightened. And I'm wondering whether there's another leg of that tightening to come. If you're sitting in a money market account right now, you're looking at kind of a bit of FOMO, you're trying to figure out what you do. Do you go into some of that credit trade to pick up that extra yield? Is there another leg to tighten that market up?
It is a tricky space, I think, credit right now, exactly because of the level of tightening that has happened, especially in this first part of the year, really, both in high yield and investment grade. I think there is an opportunity in the sense that corporates do have time, because we know that the refinancing wall is not imminent, and therefore, if those rate cuts are coming, you might still benefit from being positioned in investment grade and to some extent in high yield. But should these rate cuts being pushed forward and start to affect the refinancing goal of some of those companies, that you might see a little bit more volatility in this space and potentially a bit of widening of credit spreads. But I think it is an opportunity to have at least some exposure to those markets and portfolios today.
Okay, Maria Monici, thank you very much indeed. Fund manager, of course, at M&G Investments. Thanks for coming to the studio this Monday morning. Let's check in then on some of the individual stocks on the move and bring in Joe Easton. Joe.
So here's the price on Currys. We're down around 11% at the moment at 58 pence a share, 57.50 as Elliott walks away from that bid. Now their preliminary offer was at 67, so we've lost almost 10 pence on that one. But as we said in Stocks to Watch, JD.com still in the market and potentially has another week to make a bid. But that stock coming down today. But take a look at this massive mover in the UK, Vanquis Banking Group. It's a smaller bank based up in Bradford in Yorkshire. Massive profit warning today, saying they've seen an increase in complaints potentially related to some of the FCA scrutiny on the sector at the moment. So down 40%, 38% now for Vanquis. Then LEG, this is in German real estate, better than expected dividend from them. It is a bit of a bellwether in the European real estate space today, so that getting some positivity, up 3% this morning. But Kenco Coffee on the radar. JDE Pete's a shock resignation from their CEO this morning, and that stock coming down 4%. The market wasn't expecting that one. It's hitting the stock over in Amsterdam, so that one down around 4% today. Then we'll take a look at a couple of tech stocks. One of them, BE Semi, cannot catch a break at all. That stock fell 10% on Friday. It's down another 11% today. Concern around Samsung moving away from some of their processes, hitting the manufacturing company in the chip space. We've got a couple of other chip stocks here, ASML and Soitec, coming down given the weakness in the sector. We saw Nvidia falling sharply on Friday, so potentially some read across there. But in the positive space, we've got Telecom Italia, an update on their debt load, reassuring around the sale of their grid business and how that will affect their balance sheet. So that one is coming up a little bit in Italy, up around 2% at the moment. We'll have a quick look at some miners. You mentioned earlier a 4 to 5% drop in some of the iron ore futures overnight in Asia, and we are seeing weakness, as you mentioned. Rio Tinto, Anglo, SSAB in Stockholm and ArcelorMittal all coming down following the decline in the base metal overnight, so that is a weak spot. Then just a couple of morning calls to bring you. Firstly, Marks and Spencer's. This one is upgraded to outperform over at RBC Capital. They say that the UK consumer outlook outlook is improving as the Bank of England heads towards rate cuts later this year. So that one is positive for that one. And finally, HelloFresh. 5 brokers have downgraded the stock since that huge profit warning on Friday. The stock fell 40%. I've picked out Jefferies. They've got a 750 price target, so still they do think it could come up from where it is now, but it's down another 1.6%, adding to that massive record drop on Friday. HelloFresh getting a number of downgrades this morning.
All right, Joe Easton from our Equities team, we thank you so much for walking us through what's moving this morning. So Joe covered the stock story, the bond story we keep coming back to. We've got the BOJ and the hiking bets there. We've got the CPI in the United States. We have UK jobs for the gilts market. There is this kind of geopolitical read-through into the European bond market, I would think, which brings us to the Portuguese election. I'm curious how you trade around that. I'm curious what the policy looks like, and that feels a little fuzzy to me in terms of what the read-through is.
Well, it's interesting when you think about some of these right-wing. So it's a coalition that's going to come out as a result of the vote in Portugal. But there has been this right-wing party that's surged in terms of the vote that came through, and it was really just from 2019 in terms of the seats that they've added. But there is a story around these right-wing parties. You think of Maloney, where the rhetoric is not matched by the reality when they actually get into office. So the concern out of Brussels around what someone like Maloney might do, and actually she's tacked further to the centre, arguably at least on the economics, that has assuaged some of those concerns. So whether or not that continues to be a story, maybe is a factor you have to think about as you look at those periphery spreads.
I would have thought you'd have to put some sort of a discount into the Portuguese story this morning just for the political instability, because it looks like you're not with the minority government. I don't know how you deal with that. I think the Maloney story is interesting in as much as what she has done is spent aggressively since coming into power. And it's been interesting, the BTP spreads have tightened up, but in reality, you do wonder whether there's a chance that comes to an end soon.
And remember, Portugal and Spain now have that extra incentive, just given the decade history that they've had, to really target their debt to GDP, to really kind of bring their finances in order. And that's part of the election story. We're going to dive into it a little bit more after this break, as Portugal, as we just discussed, joined Europe's shift to the right. The Chega party surging in support in the country's elections. I'm going to say this right. We walk through some of the repercussions. We're going to walk you through more. Stick with us. This is Bloomberg.
There is no digital without chips, and I emphasize that because everybody speaks about the digitalization of the world. And I would even go a step further. There is no Green Deal without chips. So yes, it's a bit like the new oil for the world. And given some of these geopolitical tensions, especially between the US and China, it's become a necessity, I believe, to be more resilient against these geopolitical tensions. And while finding it out the hard way through the past 2 years during the pandemic, and what I mean with the hard way is that we've all seen how key industries in Europe and the US, especially in the industrial, medical, and automotive sectors, have suffered from a shortage of semiconductors.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
This is Markets Today, 23 minutes into the trading session so far. The European benchmark down by 0.3%. To the politics of the Eurozone now, and Portugal's centre-right AD coalition has won elections held this weekend in a tight race which saw support for the far-right surge. Only founded in 2019, the far-right party Chega recorded the biggest jump in support, quadrupling its representation in the Portuguese parliament. At this point, let's bring in Bloomberg's Ben Sills for the details and implications. Ben, what do we know about the vote? What does it leave? Where does it leave Portugal?
Well, in terms of Portugal's future in the short term, we're looking at a minority government. The centre-right, who came out marginally ahead of the socialists in terms of seat numbers, have said they don't want to go into coalition with Chega. So that means minority government, probably a degree of instability, and questions about exactly how much momentum the new Prime Minister is going to have for his policy plans. In terms of the bigger picture, as you rightly pointed out, the really interesting thing here is the arrival on the scene of Chega. They had 12 seats after the last election. They're going to have around 50 this time. And that shows that Portugal is now part of this broad trend that we're seeing in Germany and France, in Italy and Spain of far-right parties coming in with 20-25% of the vote. And that really does kind of change the complexion of European politics as we look towards the European Parliament elections in June.
So change the complexity of European politics, but also change the complexity of perhaps the economic story as well. Ben, Portugal has really been targeting its debt and its ballooning debt that it hasn't really been able to tackle. I think a debt reduction of 100%, almost 100% last year. Where does the new party stand on the economics? What does policy look like here?
It's tricky. They've really had quite a strong populist platform. Within these different far-right parties that we're seeing, there's very different sort of approaches. Meloni in Italy, who is the Prime Minister, obviously, has been pretty pragmatic. She throws a bit of red meat to her base with some uncompromising comments on migration, particularly. But when it comes to economic policy, she's proved herself to be really quite orthodox in many ways. Chega's a different proposition because they're at a different stage in their evolution. They're not going to be in power, so they have none of the problems of actually dealing with the consequences of populist policy. So that's going to give them the freedom to be really kind of shouting from the sidelines and trying to push the weak Prime Minister into more extreme positions.
Ben, great stuff. Thank you very much indeed for the update. We've also been educating Crudy this morning on Portuguese custard tarts. The best start to the morning, little espresso, little one of those. That's a sugar hit and a caffeine.
It's the flakiness around the edge.
Well, now Guy has to bring me one.
Okay, I'm definitely up for that as long as I get one as well. Up next, we're going to be talking about what's happening in Japan. Are we going to see a move from the BOJ in March? We'll talk next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Hear people saying, I want my little boy to grow up to be an insurance person. Did your parents tell you to be in the insurance world?
I really liked the insurance sector at the time. We are basically promoting and ensuring social cohesion. And at the time, I wanted to make a difference and wanted to go in there.
Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything.
Minutes into the session, we're up and running here in Europe. Equities fairly flat at an index level. London, interestingly enough, is higher because of the drug stocks, but we are seeing significant weight being added by some of the mining stocks today. Bonds actually are generally a little bid today. We're seeing yields coming a little bit lower. I think you're going to see a quiet bond trading in advance of that CPI print that we're going to get out of the States tomorrow.
The CPI print, there's plenty going on in the global bond rally space. You've got UK jobs tomorrow as well, so that's going to move perhaps gilts as well. You've got the election read-through from Portugal, but also from just other kind of European stories. I imagine the Ukraine story, the Israel story will ultimately at some point have some sort of read-through in the bond market, even if it's not immediate. And then we've got the BOJ, which is kind of doing its own thing.
Well, it is. And it was interesting listening to our guest earlier talking about the fact that the window potentially is closing, though.
Yeah.
If you assume that other central banks are going to cut fairly soon, does the BOJ need to get its hike in before those cuts come through? Is it independent? And if the Fed was to push out its window for that cuts, does that give the BOJ a little bit more time maybe to deliver that decision and get the market offside?
So we're thinking about the sequencing, not just of individual banks, but individual central banks, but central banks within that, of course, universe of other central banks in terms of how they sequence that is really interesting. As you look at the strength of the yen coming through today and the hit to Japanese equities.
You read my mind. Let's talk about the strength of the yen, because that is what everyone's expecting, right? We go through this kind of story every single time as we get closer and closer to this BOJ meeting. Everyone says, all right, this is it. This is the time they're going to hike. And as our guest previously said at the top of the show, that's a trade that goes wrong almost every single time. Yeah. Does it repeat this time around? Which brings me to one of the charts that caught my eye, which is the options market quite literally pricing in that narrative, this idea here that yen is ultimately going to rally. And that's what the options market is showing. You've got these 1 month risk reversals at the nearest or lowest level, I should say, of the year. It basically signals this idea that you are going to see some sort of bullish run. Let me bring you through the other side of the trade, though, because not everyone thinks this is that bullish yen moment. In fact, if you look at how some of the markets are positioned, asset managers, leverage funds, for example, they're actually very bearish on the yen. They're not touching this. And I'm curious how much of that is a fundamental story when you look at this net short position, which, by the way, is at its lowest going all the way back to about early 2022. Does that suggest some sort of different fundamental story on Japan, or do you just not want to touch Japan at all? Tom, Guy, I'm going to connect these dots here because one of the reasons that I think off the back of Ukraine and Russia and the volatility there in the oil market, trust me, I'm going to connect the dots, I promise, was nobody wanted to touch oil for a while. So you saw open interest just drop, and people interpreted that as, okay, well, maybe this doesn't have a read-through, when really macro investors just didn't want to be touching commodities in general. And I'm curious if Japan is the same story. You see so much volatility, so much uncertainty around this country. To what extent do people just not want to be exposed at all?
To Japanese yen or Japanese equities? Because clearly they wanted to be exposed to Japanese equities, and when you speak to the fund managers, they say it's still not enough is diversified to that part of the world. There's still money that can be put to work on the Japan stock story. But then a point that you brought up today as well, guys, to what extent it's actually been all about the weakness in the yen that's propelled the equities upside trend versus the corporate governance story.
Yeah, because that's the danger. If it's the yen trade, then you're going to see that trade being whipped around, and you don't have a sort of hard handle on what is happening. If it's the corporate governance narrative, i.e. that is a long-term, more structural story that is evolving in Japan, that's a much easier sell than potentially kind of the equity trade is just a derivative of the yen trade, which could get whipped around. And it'll be interesting to see what kind of volatility we end up with here. To your point about, do you want to touch it? Do you want to be involved with this? I think, yes, you probably do, but I think we are now beginning to get a greater understanding of the reason why that trade is happening, and maybe that shakes a few people out.
But why? So I guess now we have to go to the nitty-gritty of the Japanese stock market in particular. Let's really nerd out, now that you guys have wakened the beast. Let's talk about, instead of being exposed to Japanese equities as a whole, where within that are you exposed? Because initially what led to the Japanese equity rally was this chip rally you saw in the United States that then bled into Europe, that then bled into Japan. Now I'm curious, when you kind of look through the nitty-gritty, if you're talking about higher wages ultimately, that eats into the bottom line of a lot of Japanese corporates. But then if you talk about an interest rate hike or going off negative rates, does that just make Japanese banks all the more attractive?
So you short the automakers and you go long the banks in Japan.
Short the exporters.
Short the automakers because they export, or the exporters within that basket, widen the basket and go long the banks.
Is that a wage story, though? Is that the reason?
Well, it's a wage story for the automakers because higher wages, but then, of course, they sell the stronger yen, making it more challenging to sell. And then the banks, obviously, as you say, on that higher rate environment. And you've seen the Japanese banks, in the last few weeks doing very well on the back of that narrative.
You could also look at the retailers. It'd be interesting to look at the domestic story. There is this increasing argument that actually higher rates are good for the economy because in some ways you're getting an income and that's driving consumer spending. There was some interesting comments, I think it was from M&S's chair over the weekend, talking about the ineffectual nature of some of the rate rises and how they haven't contained inflation. In fact, in some ways you could argue they've spurred it. Let's talk more about what is happening with the Japanese trade. I can't talk either this morning. M-Life strategist Ven Ram joining us now. Ven, what do you make of what is happening here? Just give us a sense of your feel of what positioning looks like. What is going on? Is it this month, next month? What difference does that make in terms of the positioning story going into the BOJ?
Morning, Guy. It doesn't make a whole lot of difference whether they do it this month or next month. The fact is that the yen is deeply oversold and deeply, deeply undervalued. If you look at purchasing power parity, if you look at real effective exchange rate of Japan, it's more than 2 standard deviations lower. It couldn't get any weaker and any cheaper. So if you're going to buy into this narrative that the Bank of Japan is going to raise rates and they will get to 25 basis points by the end of the year, you've got to think that the long yen position has got traction from here. And mind you, considering how deeply oversold the yen is, these are the easy yards for the yen to appreciate. Until at least 142 against the dollar, those will be easy pickings. It'll be what happens to the yen after that that'll be interesting.
What about the yield curve control story, Ben? There were some reports this morning that maybe they were looking at scrapping that as well. How consequential would that be? And what is your thinking of the flow story then into Japanese assets if that negative rate regime is ended?
Hi, Tom. So, on the yield curve story, I mean, the fact that they are going to pre-announce the amount is very positive for the yield curve. I mean, it is going to widen much more, and that is going to be positive for banks, as you were mentioning just earlier on. In terms of flows, I think that the Japanese stock market as a whole is going to be vulnerable because of how much weighting it has to automobile companies, their exporters, and they will suffer as a consequence of a stronger yen. Now, I just ran some numbers just before I came here. And if you look at the correlation starting from the start of the millennium, what you get to see is the stock market can withstand a rise of about 5% in the yen before it all goes pear-shaped for stocks. So, and for another 5% of gains, stocks are going to be doing okay. After that, they will be in for some testing times.
So, Ben, if you do see this kind of fund flow, as Tom was pointing out, into Japanese equities, into the yen, for example, that you say is oversold, arguably even JGBs, what would the trade-off be? What does it come in at the expense of? Does it come at the expense of gold, for example, which has been enjoying its own rally? Is there some sort of risk-off gauge there, risk-off relationship? What do you think?
Well, I think that the dollar is kind of overbought at these levels, and I think that what we have seen in the past week is likely to evolve into a bigger picture, into much more of a bigger focus for the markets. I mean, I think that the dollar has proved extremely resilient, but if the markets and if the Fed is going to be willing to cut rates later this year, I think that the dollar will cop it, and at the expense of the dollar, other currencies will gain. And we've already seen that happen to some extent with the yen. We are seeing that happening with sterling as well. And I think that's the way forward. Not so much in terms of gold, though, because I ran some numbers before I came in again, and I see dollar capped at 2,300. Interestingly, on gold, gold ended 2012 at 1675 an ounce. If you adjust it for inflation, it is still trailing those numbers in terms of inflation-adjusted levels. So, I'm not getting too excited about gold from these levels.
Ben, nice to see you. Thanks for stopping by. MLive Strategies, Ben Ram, joining us on the kind of the yen trade into the gold trade. I'd add Bitcoin in. Bitcoin continues to crash higher. It's amazing how this sort of melt-up story is happening. Does it have legs? Do we see a record? What does it tell us about what is happening in this broader market right now? Is this the ultimate froth story, or is there something that is a little bit more fundamental to what is happening here?
Well, now that you can buy Bitcoin via ETFs, so you have that kind of institutional protection versus having to go onto some brokerage, put it on a cold wallet, all of that nonsense that made it very difficult. The usability is still not there, clearly, for Bitcoin, but the fact that you have the institutions behind it, you buy the ETF, you have it as an asset, 5% of your portfolio, and just let it run. And then the halving story that happens in April, so that they cap the number of Bitcoins on the market. Ultimately, they want to keep it at 21 million. Kind of. That seems to be the fundamental. 71,000 now.
Yeah, we are seeing coins. Dogs with hats. Can't believe I get to bring that up again.
That's where you put. That's where you put.
You've been waiting all morning.
All morning to talk about this. I really want to talk about the rugby, but I've been waiting all morning to talk about that. But the fact that these are the other these coins are going crazy as well. Yeah. That speaks to the froth story maybe a little bit more.
It does, but isn't this just a very simple? This is now a passive ETF, passive income. Isn't this more of a fund flow story than I want to buy at $71,000?
I think you're probably right, and you look at where the flows are coming from. It's more institutional than anything else. But if you could take Bitcoin in isolation, that would be maybe you could kind of make that argument a bit more strongly. But the fact that other coins, the altcoins, everything else are doing so strongly, are doing so well, they're even outperforming what is happening with Bitcoin at the moment. Yeah. That's where maybe the froth argument comes.
I mean, how you can say that the upside that we've seen with dog with hat is not frothiness? I don't know how you made that argument. There's no fun. You have to split the two, don't you? You have to look at Bitcoin in the ETFs as one asset class. And then dog with hat, I don't know if you want any exposure.
He's more excited about this than I am.
Because
it's literally a dog with a crown or a hat, isn't it? That's it.
I know nothing about this. I admittedly am out in the cold on this. So I'm going to bring it back to something I do know, which is crypto stocks. There's a fun little 1 hour time change that's happening at the moment where we're 41 minutes into not only the European session, but the U.S. pre-market session as well. And you're already seeing a lot of these kind of U.S. stocks that are exposed to the crypto story rising quite a bit. So Coinbase, for example, has the exchange higher by 5.3%. The one that I always look at, though, is Robinhood, because even though it's at an exchange, 60% of their revenue comes from crypto, which is a retail story. Those shares are about 2% higher as well.
You feel closer to home.
I do, just by saying that.
4 hours.
You brought up rugby, dogs with hat memes, Portuguese custards. Like, what am I supposed to say to that?
I think you brought it home for yourself. Very nice. 4-hour difference.
For
time
us,
difference.
for the global audience.
For the whole, what haven't we touched on? There you go. Coinbase is up, what, 5.5% or so? Is that what's happening? The upside's coming through for that. Interestingly, the ARC's Kathy Wood, thank you for filling in the gap there. Kathy Wood saying, trying to make the explanation around why she hasn't got that exposure to NVIDIA. So she's funded the trade into Coinbase using the holdings in NVIDIA that they had 12 months ago or so. And she says the upside for Coinbase is made up for that.
Hasn't she said, wasn't she made, was she the one who said 100,000?
She did say that.
Yeah.
She did say that a couple of years ago.
Yeah.
71,000 now.
She's not looking crazy now. She did at the time.
Yeah, but it's interesting that trade is working out. NVIDIA getting absolutely battered on Friday. Okay, coming up, we're going to change the angle a little bit. We're going to talk more about India. India is signing a free trade agreement with 4 European countries. These are EFTA countries. We're still waiting to see whether the UK can pull off something similar. Can the EU as well? A deal with the Modi government. Potentially it's going to create 1 million jobs. There's a huge investment aspect to this into India as well. What does this tell us about the India case and what its impact on the global economy is going to be? Details to follow. This is Bloomberg.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but where it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California in San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
47 minutes into the session, Monday the 11th. To be honest, we're drifting sideways. We're a little softer than we certainly were at the get-go of trade. So we're softening up a little bit here in Europe. What you're basically seeing is a read across from what we saw Friday out of the States. Some of the tech stocks are a little bit lower. The miners are lower. What is interesting is that what is lifting Europe this morning is some of the drug stocks. I do want to talk about what's happening in India. I don't want to talk about the cricket, but I do want to talk about the free trade pact that has been signed with 4 European countries. The Modi government says that this will create 1 million million jobs. There's a huge investment component to this. The deal is with EFTA countries, i.e. non-EU countries, including Switzerland, Norway. It's been a long time in the making. There are other negotiations as well with other groups. It's been basically 16 years in the coming. Rishi Bhaa joins us now from New Delhi. Talk to us about this deal, what is in it, and whether or not it can be a template for other deals that are coming as well.
Oh, well, yes, in a big way, it could be the template for some of the other deals or the free trade agreements that are in the work. As far as the trade pact with EFTA nations is concerned, it was in the making for almost 16 years, and it comes with a promise of almost $100 billion worth of investments in the South Asian country over the next 15 years, as well as a promise of creating almost 1 million jobs. India is a big market. It's the world's most populous country, and also one of the world's fastest expanding economies. So definitely for some of the EFTA countries, they are hoping that they get market access to this big nation. As far as some of the sectors that are concerned, we do understand that the medical sector, the pharmaceutical industry, the health, computer, as well as banking and insurance sectors will be the ones that will be benefiting in a great detail. As far as India is concerned, Indians can now enjoy cheaper Swiss watches and Swiss chocolates. You're right, this would be a template, so to say, because this for the first time that we've seen an investment clause that has been added. That has been added in the trade pact. It is modern day trade pact of sorts, which includes areas such as labor movement as well as environment and gender as well. Also, what is quite interesting is that this pact is coming in just ahead of the national polls, and the fact that the government has been able to clinch it at a time when they're looking at getting more investments into countries and companies that are looking to move out of China is pretty interesting, so to say.
Rishi, to your point, it's not just Swiss watches and Swiss chocolates, but of course Indians want access to a lot of different markets and vice versa as well. India's famous for not allowing multinational companies to have a direct kind of presence there. They have to do it in partnership with an Indian company. I'm curious if this kind of opens the door towards more international deals, though. India with the EU, the UK, Australia, even the United States. What does that look like?
Well, absolutely, you're right that it's not been easy to forge these ties with India, because India has traditionally had protectionist policies, but now we're seeing some sort of a shift in that ideology. In fact, India is now looking at forging deeper ties with some of their trading partners, so that India can become a manufacturing powerhouse. They're able to create jobs for the millions of people that are entering the workforce. In fact, while this EFTA deal has been done, there are two other big ones that are in the making. While we do understand that the UK FTA has hit some roadblocks, the government will try to pursue some of those after the national polls. The big one is also going to be a trade pact with the European Union, and that's going to be a big one. India is close to finalizing a deal with Oman as well, and that's also one of a kind deal of sorts. There are, remember, as far as the Middle Eastern nations are concerned, India has signed a free trade agreement already with the United Arab Emirates, and talks are underway with some of the Gulf countries as well. So the country is taking the first few steps. Of course, a lot will depend on how hard these negotiations are for them to be able to clinch some of those deals.
Bloomberg's Rishi Bhaa walking us through some of the details. We thank you so much. And as Rishi was saying, there's different pieces of this. India's targeting a lot of different countries. The protectionist policies, I think, are really fascinating, because they did this when food prices were on the high. They did it with rice exports, for example. They're famous, like I said, for not putting multinationals and allowing them in. IKEA was a great example. McDonald's, Starbucks, for example. You had to partner with some sort of Indian company to get that kind of access. To me, the most recent example is right back here in Europe, Sephora, now getting into India as of, I think, November of last year, in conjunction with the Ambani family, which had just bought the rights to Sephora India, and now allowing that access.
Well, and to the UK, so that protectionist recent history is really, really important when you think about the need for that stability if you're investing in that market. So British negotiators have been on the ground in India trying to move forward the trade deal, the potential trade deal between the UK and India, and our reporting is suggesting that's going to be sidelined until after the election. A massive year for India when it comes to the vote, and that happens in April. Modi's expected to win. His BJP party, of course, expected to win very easily. But it seems like the UK's own trade deal with India has to be put on pause until at least after that piece of politics.
I think it's fascinating that EFTA countries have done this first rather than the UK. The UK, strong connection. That hasn't delivered the early deal, and it'll be interesting to see. I'm fascinated to see kind of where the UK ultimately goes in its relationship with Europe. EFTA. If EFTA can get some of these deals done, does it make it more of an enhanced prospect from a UK point of view to rejoin EFTA? And maybe short-circuit some of these trade deals getting done. I think there's a number of ways of looking at this. You can look at it from a UK point of view. I think the other relationship is India and how it strategically fits into this. You look at Apple and the importance of India and how, as China sags, how can India replace some of that story for companies like Apple? And
then, speaking of India, the U.S. story as well. But one of the concerns from the U.S. side is that because India has a defense agreement with Russia, because they're buying Russian oil, there's a lot of questions about, okay, well, to what extent do you kind of tease that relationship out? Do you sanction the companies that are associated with it? Does that get in the way of a trade agreement? And does that all even matter in a Trump 2.0? It might not.
That's a really interesting point, because we've seen the sanction impact on US companies in terms of the concern about exposure to Chinese market. And look, India is a vibrant multi-party democracy, but there are critics who say he's a nationalist, a Hindu nationalist, there's been a crackdown on Muslims, and then you have that additional dynamic around, they have not pushed back on Russia's invasion of Ukraine. So at what point, as you build out your presence in India, do you have to be cautious of some of those aspects as well, longer term? Maybe?
And to your point on China, Europe did this, right? Europe actually put in sanctions on certain Chinese companies that were dealing with Russia as well. So now I'm curious, as Europe in particular tries to fund the rebuilding of Ukraine, does Europe then go hard on India as well to make a point, or to actually be very serious about where those funds are coming from?
So we started the show talking about geopolitics. We're back to talking about geopolitics at the end of the show. Is that actually going to be the narrative that actually has a bigger impact this week, or is it going to be the macroeconomic data? Is it going to be stories like the CPI data and what ultimately comes out of the UK on the wage front as well? The former is much harder to price. The uncertainty surrounding some of these stories is much more difficult to deal with. What happens with the Hamas story, I think, has many implications, but really difficult for the market to get a handle on. The data is an easier trade.
But I think that's also part of the kind of rhetoric around this momentum trade, that you just buy tech, you buy bonds, you call it a day, or sell bonds, whatever your bond trade is. I'm still very confused about that one. But at least the equity market, this kind of fund flow into the equities, if everyone's buying equities, this is a really easy way to hop in on that trade right now. Whereas while you're figuring out the geopolitics of it all. And I think that's maybe part of why there's kind of this one-way move. I don't think it's just a AI story or a tech story. It's why even with some very high valuations, the likes of JP Morgan are saying, well, actually, it's fine to hop in now.
Still potentially significant upside still to come. There are plenty of cautious people out there that are signaling that maybe this market looks stretched. Will that CPI print prove pivotal? Inflation has been the undoing of this kind of Goldilocks scenario. And I come back to the question I posed a little bit earlier. Is Powell setting us up again? Thursday, he sounded very confident in his ability to cut rates. Does the inflation argument ultimately undo that? And is geopolitics part of that narrative as well?
Well, we heard Christine Lagarde mention geopolitics, didn't she? She said that the risk is kind of warming up there. Chair Powell still hasn't done that. And to be fair, I think there's a very more clearer, a direct rate through into Europe than there is in the United States. But who knows?
Iron ore's getting sunk pretty hard once again.
Down 7%.
That's a disinflationary trade as well. That's what the week looks like. We hope we've set you up nicely for that. You don't want to miss Bloomberg's exclusive interview with Pascal Donoghue. He's coming up. Remember, he's the president of the Eurogroup. Lots to talk about there. I wonder whether that trade story will be part of the narrative. We'll be talking to Pascal in the next hour. Francine Lacroix will have that conversation. Very much looking forward to what that looks like. It's going to be another busy week. We'll be back again tomorrow. Francine takes over now. The Pulse is next. This is Bloomberg.
was around so many powerful people my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, you know, any given day it would be the head of a studio and, you know, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse, an hour earlier than usual because the clocks have moved forward in the U.S. That's for the next 3 weeks. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Wall Street futures slip, European stocks fall as traders turn their attention to U.S. inflation data due tomorrow for clues on the timing for future Fed rate cuts. Japanese stocks slide sharply as the yen jumps on speculation that the BOJ meeting later this month will actually deliver a hike. Plus, U.S. President Joe Biden warns Israel against invading the city of Rafah, calling it a, quote, red line as ceasefire talks remain deadlocked. So let's take a look at the European markets map, but overall there's quite a lot of markets news across the board. So this is a picture for the stocks. If you look at the DAX, but also the CAC 40 and over the FTSE over in the MIB in Italy, we're seeing a lot of pressure as, of course, that CPI inflation data tomorrow will probably change everything depending on whether it comes in hot or not. It will test definitely the market's conviction about the next cuts and whether, you know, his colleagues are actually moving closer to dialing back their inflation fight. Now, the picture across the board, actually a little bit of this downward movement is also filtering through U.S. futures. Again, some of the things that we're watching out for, so you can see the S&P futures down 0.2%, European stocks a little bit lower than usual, but Bitcoin, for example, topping $71,000 for the first time. Again, advancing for a 6th straight day, taking this year's rally to almost 70%. That's extremely important. Then we have on the tail end of some of the earnings results, so we do have a couple of retailers here in Europe. We have Zalando and Inditex a little bit later on. And then we also look at yen. You can see a dollar yen 146.73. So to talk about these markets and the way forward for the Fed and some of the Fed presidents, I'm delighted to be joined by Eric Nielsen, Group Chief Economics Advisor at UniCredit. It must be a Monday morning if I get briefed by Eric Nielsen for the week ahead. Eric, thank you so much for joining us. When you look at the inflation figures tomorrow, there's so much pressure on that to see whether the Fed is cutting in June.
Yeah, and it's mad, right? Do we really think that monetary policy is set on the basis of one number? But that's where we are.
What do you mean? Of course.
But that's where we are, right? That's where we are because we are data dependent, not data dependent apparently in how it fits the models and therefore the forecast, but what it does now, and I think it's a madness. So
I love your pushback, Eric, because you're not wrong. But then, so what's fundamentally actually driving the markets?
Well, the very small tips, so today and tomorrow we'll be sort of very excited if you're a trader in this, but for the economy it doesn't really matter, right? And it doesn't really matter for that matter whether the Fed moves in one meeting or the next. You can't really detect that on the real side of the economy, but for the financial markets it's important. What matters is really which direction is the US going? Is the risk that you, a year from now, when this monetary policy change or not, impacts the economy? What is the risk at that time that you're a bit overheating or underheating or whatever? And there is the really interesting point, which I think is that the probability is certainly measurable that the US could need to keep rates higher for longer, but Europe not.
But okay, so this would be a very interesting dynamic. But so what are you seeing in the US that actually makes you make that call?
Still this strong labor market and wage growth is still elevated, right? You still have lots of fiscal expansion going on, and I doubt that will sort of cease into the election.
But does it actually make it, if we have, for example, Donald Trump in the presidency, we could look at further regulation? Is it too soon to talk about real policy and whether those would be inflationary?
It's never too soon to talk about bad policies, right? So, yeah, no, absolutely. I think that if Trump, God forbid, wins, you could have a rally in the short term because he's going to plow out or tax cuts, depending on whether he controls Congress or not. But remember when he came in last time, you had a nice rally because everybody got very excited about deregulation and tax cuts and stuff. So the market would like that this short term, but in the longer-term direction is another one.
Eric, talk to me about, so if Europe actually cuts and the Fed doesn't, I mean, that's an interesting dynamic because you have a pretty weak economy also cutting before anyone else and possibly for a couple of months.
Yeah, and that's what they should do, right? I mean, you should run it on the basis of your own economy, but it's rarely happened. I mean, I think they've decoupled twice, but not even really sort of in terms of actively cutting at a time when the Fed doesn't.
But does that create headwinds on financial markets, or is it just that Madame Lagarde is concerned of being the first because you don't know about the unintended consequences?
Well, the consequences would be presumably in the market in terms of particularly euro-dollar.
Yeah.
I think they should, and I think they will be quite relaxed. I mean, whether euro-dollar goes a couple of numbers lower, who cares? It's not inflationary to any measurable extent. And it would tell the market that they are really running monetary policy for the Eurozone and not just sort of backpedaling behind the Fed, which it looks like they do. I'm not saying they're doing it, but in reality, that is what has happened.
But Eric, what concerns you the most? First of all, we're largely ignoring some of the geopolitics and the impact it could have longer term on economics. Yeah. Bitcoin is at 71,000. Gold is also on a tear. I mean, it's difficult to actually looking at the markets to see a blueprint of what economy we're left with.
Yeah, no, I think that's right. I mean, geopolitics is everything now, right? I mean, and it's very worrisome. I think it's hopefully it sort of slides along, modeling along, but all the risk I can think about is sort of to the downside, right? So yeah, Bitcoin, I mean, God knows what drives this damn thing, but it's like Bitcoin or gold, it does reflect some sort of uncertainty and sufficient amount of liquidity in the system that you have people who buy this stuff.
Does China concern you economically?
Yeah, I mean, it's not massively because I think they control the economy quite well, but you're seeing clearly a slowdown, and you're seeing a more and more opaque policymaking, as you saw now latest with the cancelled press conference. So this is a big story that we don't really understand, but it is getting harder and harder. If I ran a business in China, I would get more and more nervous, for sure, right? How do you know what's going on? How do you even trust the data, really, at this stage? So yeah, I worry about it, but I don't think you will see a massive collapse in the economy or something, but it's weakening, and it's weakening medium term, for sure, right?
And that's worse for Europe than it is for the US?
Yeah, for sure. It's But again, I mean, so Europe has this massive task, really, of stop being this massive net exporter, right? And Germany being your prime example. We have to generate domestic demand. Tell the policymakers.
Up to you, policymakers, if you're watching the Pulse. So stay with us, Eric. Thank you so much. Eric Nielsen, UniCredit's Group Chief Economics Advisor, stays with us. We'll also have plenty more, of course, on China. We'll talk about commodities and oil. I think iron ore futures are getting slammed right now. Now, to some of the other top stories on the terminal this morning. Portugal's centre-right AD coalition has won elections held this weekend in a tight race, which also saw support for the far-right surge. Well, with almost all votes counted, the AD secured 79 seats, 2 more than the socialist far-right party Chega, which was only founded in 2019, recorded the biggest jump, quadrupling its representation. And Germany is bracing for further travel chaos after unions representing train drivers and airline staff announced further walkouts. Now, a 6th strike by train drivers coincides with a 2-day strike by Lufthansa's cabin crew after ground crew stopped working last week. More delays and cancellations are expected as passengers get caught up in the latest escalation of wage disputes in Europe's largest economy. And India has signed a free trade pact with 4 European countries that the Modi government says will create 1 million jobs in 15 years. Well, the deal with non-EU countries, including Switzerland and Norway, has been 16 years in the making. India is getting private sector investment commitments in return for the Europeans securing easier access to Indian markets and products. Coming up, the world's biggest crude exporter hikes its dividend despite a drop in oil prices. We take a look at what Saudi Aramco's big payout means for the kingdom's budget next. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups that we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
To the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
On your screen, slumping more than 7%, actually dropping below $110 a ton. This is after we saw disappointing demand in China, leaving the market lumbered with many inventories. So this is a steelmaking material, and it's tumbled around a quarter from a peak in early January. Again, this all goes back to China. The other commodity we need to talk about is oil. Oil extending its drop, and this, again, as investors look ahead to the U.S. inflation print. We'll talk about Saudi Aramco in a second, but we have an expert on commodities commodities. He was meant to talk Saudi Aramco. Forget about that. We have iron ore down 7%, so let's get straight to our Will Kennedy. Well, I don't know whether iron ore, I mean, is this symptomatic of how bad the Chinese economy could be, or is it just iron ore?
It's often seen as a proxy for the health of the Chinese industrial economy, and of course, iron ore feeds through to steel, which feeds through to the housing sector, the property sector in particular. It had been very strong, and to many people surprisingly strong into the start of the year, as you mentioned at the start, Francine. I suspect the sell-off probably was always coming, but some investors will have been a little disappointed by the policy and the lack of really dramatic stimulus out of the MPC in Beijing that's happened over the last week, and it may be that people are selling off as a response to that.
So we'll keep a very close eye on it. The other story, actually, I know you came on to talk about, is Saudi Aramco. So this is the world's biggest crude oil exporter. It's providing much of Saudi's government income, with the payout becoming ever more vital as it looks to diversify the economy from oil. And then they're paying out this huge dividend. So what does it mean?
I think it means exactly that. The emphasis that the kingdom is going to put from its oil industry is really paying as much money as possible, both to the government and into the PIF, which, remember, got given a bigger stake in Aramco last week, and I think owns about 17% of the company now. So you're really seeing the dividend as a mechanism to transfer wealth from the dominant oil industry into other parts of the Saudi economy, which is, of course, completely in line with the Crown Prince's plans to diversify and broaden the base of the Saudi economy.
And are there any updates on Aramco's talks for U.S. LNG projects?
Yeah, they're still talking about that. I would say that they've been talking about it for some time. I remember interviewing the CEO in 2019, 5 years ago, when he talked about it then. I think the pandemic may have put a bit of a brake on those plans, but in common with a lot of the oil and gas industry, they clearly see LNG having a growth profile that perhaps goes on longer than oil as we go through the energy transition, so maybe a useful place for them to put some of their capital.
Always good to speak to Will Kennedy. He's, of course, our Senior Executive Editor for Energy and Commodities, looking at iron ore and looking at Saudi Aramco. Now, still with us, Eric Nielsen, Group Chief Economics Advisor at UniCredit. And Eric, I guess it goes back to the point of, we're trying to grapple, for example, iron ore, and Will explained it beautifully. It may be something with iron ore more than the Chinese economy falling off its cliff, but it's unclear if China goes back so badly. Does India, what supports the global economy going forward?
It's difficult to see right now, right? If you think about IMF forecast, OECD forecast for the global economy, everybody agrees that we are slowing to 3% plus minus or thereabout. So, as Will said, it's for a while there was some sort of excitement about a stimulus in China because the two drivers of this already poor growth last year was China and the U.S. And now we know that the U.S. probably is slowing a little bit, and China is not doing what some at least thought. So now you get this pressure exactly on things like iron ore and commodities in general. Will India pick up? Maybe in the longer term. I'm skeptical that you see some sort of a massive boost forward. But remember, this is a massive sized economy in terms of population and with a huge upward scope for real income per capita. You start to multiply that into global GDP. It's measurable if they get it right?
But Eric, when you say, a lot of was expected actually of Chinese policymakers, if they're not putting the stimulus in place, is it because they have more structural problems and they don't think it will work? Or, they can't be saying, we have the magic wand, but we decide not to fix it.
That's a $1 million question. I suspect, but I don't know. I suspect it has more to do with internal power struggles. There will be, like in any major organization of a governance, like in China, people who think you should do this or this or this, sort of how important it is to slow down, type of thing. And different people come into the big guy and sort of tell ideas, but how that struggle ultimately plays out, I don't know. But I think it's a compromise type of internal power struggle. Do you do it this way or that way? What we know in the past is that when they have stimulated quite effectively short-term, but not long-term, because they put credits into the old heavy industries. So the idea of going the better way of stimulating the economy for the private sector, the more dynamic, we haven't seen this, and my money will be against them going that way.
And is a danger with India that we're expecting it to take over China with the same roadmap? and it's just a very different economy.
It's a very different economy, and it comes back to what we have talked about many times, the BRICS story about the coordination. They have very different models. They don't particularly like each other. They are like so coordination and copying from the other side. Wouldn't be your first guess, right? But I mean, India has done well lately in economic terms, and the trade deal is good, right? So it's a long run story, right?
Eric, because you're a thinker, what are you most worried about in the global economy right now? Is it a mistake from monetary policy, or is it? No. I mean. We've talked about this. I think monetary policy in Europe has over-tightened, but these small potatoes in what we are really looking at in the world. I worry about the Middle East and commodities if you're talking about economics. I obviously worry about a Chinese further push, not invasion, but say worst case blockade of Taiwan. Supply chains, these type of things. This is the stuff that keeps me awake at night. Does AI help with supply chains? Because it can predict better, or is it just mumbo jumbo?
I think it is it's a super exciting, but it's a sideshow for now, right? It's the new thing out there. All the other major inventions, if this is one of them, and it probably is, took 10, 15 years to have a material impact. So it's exciting, but it's one that needs to be regulated. We don't know how that kind of plays into it. But no, for the next year or two, I think will have zero impact on the overall global economy.
Eric, thank you so much, as always, for joining us. That was Eric Nielsen, UniCredit's Group Chief Economics Advisor. Now, coming up, the U.S. President Joe Biden's red line for Israel. We take a closer look at his warning over invading Rafah. That's next, and this is Bloomberg.
was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
U.S. President Joe Biden has warned Israel against an invasion of the city of Rafah in southern Gaza. This as ceasefire talks between Israel and Hamas remain deadlocked at the beginning of Ramadan.
There's red lines that if he crosses, he cannot have 30,000 more Palestinians dead as a consequence of going after. There's other ways to deal with the trauma caused by Hamas.
Well, let's get more from Bloomberg's EMEA News Director, Roz Matheson. Roz, what is the level of support inside Israel for an offensive in Rafah?
Well, it does appear to still be pretty strong. What we've seen in recent months is that hardening of support behind the Israeli Prime Minister Benjamin Netanyahu. Initially, there was that shock over the Hamas attack and questions over how Israel, security failed in that minute. But then what we've seen in the later times is the rallying of support behind Netanyahu for his actions against Hamas inside Gaza, the feeling that, yes, Israel cannot be in a position where it could ever be vulnerable again to a similar attack by Hamas, for support for the idea that you've got a campaign to really eradicate Hamas. So there is a strong level of support inside Israel for what Benjamin Netanyahu has been doing. And again, those promises, those threats in a way that he will go ahead with an offensive inside Rafah. But the outside of Israel, the global view on this, in the US, you saw Joe Biden just now and others, that heightened level of concern about the fatality rate inside Gaza, the long-term future of Gaza, and certainly you're seeing growing tensions between the US and Israel about that.
So, Roz, what has been Netanyahu's response to what Biden said?
Well, Benjamin Netanyahu, they seem to be talking past each other at the minute, publicly at each other. They certainly don't seem to be talking privately anymore. And they were talking a lot in October and November, and now it seems they're only using public forums to shout at each other. We saw that hot mic moment from Joe Biden where he essentially said that Netanyahu needed to have a come to Jesus moment. At some point, we saw Bibi fire back at Netanyahu overnight, saying again that the US is misguided in their comments, that they're acting in the best interest of Israel. But there seems to be no private rapport going on there, and that relationship looks fundamentally broken.
So, Roz, this is the start of Ramadan. There's no ceasefire yet. Is there still hope?
Very little hope for a ceasefire anytime soon. There aren't even any real negotiations going on at this point. There are some sideline direct conversations. The US is talking with Qatar and Egypt. Israel's talking with some, but no one's really talking directly. And Israel and Hamas are accusing the other of being the bad faith actor in those conversations. Israel says Hamas is dragging the chain on it because they do want Israel to go in, because they want to maximize the PR benefit from themselves in a way of that happening. Hamas says Israel's not talking to them properly. So basically all lines of communication on that have broken down. We're in Ramadan now. The question is there a point in the coming days or weeks where Netanyahu does make good on his threat to go into Rafah?
Roz, as always, thank you so much for coming on. Bloomberg's EMEA News Director, Roz Matheson. Now, this is a picture across the board for example, U.S. futures. It is a data-heavy week that will test the market's conviction that the Fed's Chair, Jay Powell, and his colleagues are moving closer to dialing back their inflation fight. So we have U.S. inflation data tomorrow, and then Bitcoin topping $71,000 for the first time. Coming up, investors looking ahead to that data after Friday's mixed jobs report. We'll have a preview next, and this is Bloomberg.
timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? Are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Wall Street futures slip and European stocks fall as traders turn their attention to U.S. inflation data due tomorrow for clues on the timing of future Fed rate cuts. Japanese stocks slide sharply as the yen jumps on speculation that the BOJ meeting later this month will deliver a hike. And U.S. President Joe Biden warns Israel against invading the city of Rafah, calling it a red line as ceasefire talks remain deadlocked. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, there's a lot going on in the markets. Again, all eyes on that inflation print tomorrow. We pretty much have a big data-heavy week. The market will be tested with its conviction that the Fed, Jay Powell and his colleagues are moving closer to dialing back their inflation fight. Now, if we look at swap trades, they see the first cut in June as a virtual lock, nearly 4 quarter points cuts than expected over the next year. Again, a stronger than anticipated jump in consumer prices tomorrow could upend that pricing and further derail the stocks market. You can see NASDAQ futures pretty much unchanged. European stocks down 0.4%. Now, traders on high alert for that hotter than expected U.S. inflation print when the latest data is published tomorrow. So for more on all of this, we're joined by Mads Pedersen. He is founder and chief investment officer at Human Edge Investment. Mads, thank you for joining us. It seems so crazy that actually all relies on that U.S. CPI print. I don't know whether there's too much anticipation on whether it makes a huge difference for equities and even for treasuries if we have a June cut or whether that's pushed back to July.
Well, thank you very much for hosting, and thank you for inviting me. I don't think it matters for where we end the year what we'll get of a print tomorrow, but of course it will matter because markets have moved up dramatically and markets have had a very strong support the last year from the decline in inflation. So if we get a hiccup, it will matter. People will probably lose a little bit the perspective on how positive the inflation story has been, and there will be an opportunity in the market. But in the long run, inflation is coming down. The Fed will cut, as you say, and we expect them to be at 3.5% or 3% in 2 years. So the big picture won't change, but it could create a very interesting week if we get a negative surprise.
When you look at some of the things that you watch out for, right? Credit costs down, U.S. employment growing rapidly. What worries you, if anything, about the U.S. economy? Are you expecting to overheat it because it's firing on all cylinders right now?
Yeah, you're right. It's everyone was talking about a soft landing or a hard landing, and for a year we didn't get a landing at all. So what we are saying now is it's probably as likely, at least, that we don't get a landing for the next year. And then, of course, the worry will be, We don't think we're in a bubble, but when will the equity market then enter a bubble? And we think inflation will be trending down. We think the ECB and the Fed will be cutting, but they have not been, say, as consistent as one could hope for. So the question is, will the inflation make them comfortable? Because it's a very comfortable inflation backdrop. Yeah, we came from 6-7% in the US down to 3%. It's very good development, but when will the central banks become comfortable with that? And how long can the market deliver the earnings which have surprised so positively the last year? So those are still the main determining factors for the market, where we have a very positive outlook.
A gauge of the dollar is actually on track for a 7th day of losses. Where are you expecting, Mads, for dollar to be at the end of the year, and how does that actually impact your thoughts on treasuries, but also on some of the earnings that you watch?
Yeah, so we expect the dollar to be roughly at the same point at the end of the year, because what is supporting the dollar, what is undermining the dollar a little bit, tiny bit at the moment, is not a huge movement, is that the Fed has clearly said also last week that they will be cutting, and the ECB is not so much ready to do it. If you look at the numbers, it should be the other way around. Germany is not growing at all. Inflation in Europe has collapsed from 10 to below 3. In the US, it's more like from 7-8 to around 3. So actually, the ECB has more reason to cut and should do it, but are more reluctant. And that we expect to turn around as the evidence comes in that the ECB really has to cut. So that will support the dollar in the long run. For our positioning, well, it means that we are in our European portfolios, we keep the dollar open. So we keep 20-30% in our Swiss franc and dollar portfolios. We hedge the currency fully because we do think that if things go wrong, the euro will fall out of the bed again and we go back to parity if the world turns negative.
Mads, I'm not surprised, but actually have zero allocation in China, which for some would be quite surprising. Do you write off China for the next 5-10 years?
I don't write off China for the next 5-10 years as a very, very interesting, dramatic story. But Xi has made it clear he likes to rule China. He has made it clear he does not consider equity owners or equity markets of any importance and will not respect them. Nobody knows how much debt there is in China, or if they know it, they don't want to tell us. We don't really know how much the local government financing vehicles have of debt, but something like 60-70% of GDP. So I would find it pretty reckless to invest in a company where the owner doesn't care about the shareholders or the CEO you could compare it to, and you don't know what debt there is. And in China, we have a situation where everything which is surprised positive in the US is surprised negative in China. Growth, the IT sector, the housing sector, all negative. And we don't know what the debt burden is. They simply don't want to tell us, or they don't know. And the one is worse than the other. So we just don't want to be exposed to that, at least not for my own money and not for my client's money. Yeah, so that's the simplest news.
Fair. Mads, I'm also surprised to some extent that you're expecting a boom in M&A for the financial sector in Europe. We've been talking about it for 10 years. I always thought regulators were not quite behind, and we never had the capital markets union that would make a real difference. You're confident this happens this year?
Yes, I'm confident it will start this year because it's a little bit controversial, but the European banking sector is still run by men, and when men, they get money, and the banks are making a lot of money now, they tend to spend them on toys. And now banks are not toys, but a lot of banks are making a lot of money based on the policy mix the ECB has chosen. They didn't expect to make these money, and now they're trying to find out how to grow. So one easy way to grow is to, at least to get growth numbers in, is to plan M&A, and it's a lot easier to buy when you have money than when you don't. So now they're making money and they would like to buy, and it makes a terrible lot of sense. Yeah, there's a lot of rationality and rationalizations you can do with AI. It's expensive, so you'd like to merge. So we have a story which is consistent. We have people who like to spend money, and they now have money. So I'm quite confident they will start spending them.
Mads, thank you so much for joining us. That was Mads Pedersen, a founder and chief investment officer at Human Edge Investments, with some pretty bold calls. Now, Telecom Italia, let's look at what that's doing. Trading has been halted this morning. The company is seeking to reassure investors that a 22 billion euro planned sale of its network business later this year will allow it to meet its debt-cutting targets. Now, in a strategy update released this morning after an unprecedented market sell-off, the company also said that even if its debt will continue to rise this year, it will be able to meet its multi-year guidance, which was put under question by analysts. And then this is a fun story. Vinyl records will return to the UK inflation basket for the first time in 32 years after a surge in their popularity while hand sanitizers is out. I feel like they're talking to me because I went just the other day actually at Notting Hill to try and find some vinyls. The Office for National Statistics said that air fryers, rice cakes, and gluten-free bread will also be added to the basket to reflect changing eating habits. Now, the shakeup is part of an annual review of consumer goods and services that the ONS samples. Now, coming up, EU finance ministers are meeting today in Brussels to discuss the future of the Capital Markets Union and the state of the European economy. Well, I'm delighted to be talking exclusively to the president of the Eurogroup, the body that brings the bloc's finance ministers together. That conversation with Pascal Donoghue is up next, and this is Bloomberg.
Let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
EU finance ministers are meeting in Brussels today to conclude plans towards a capital markets union. Well, I'm very pleased to be joined now for an exclusive conversation by Pascal Donoghue, the president of the Eurogroup, the body, of course, that brings together the finance ministers of Eurozone member states. So, Mr. Donoghue, thank you so much for joining us. The capital markets union, I know it's always a bit of a question on whether we'll see something concrete in our lifetime, but this is a key issue for you and your colleagues, of course, meeting later today. How much support do you have for your plans?
Good morning, Francine. I'm very confident today that we will get a plan agreed. We will get a plan agreed because we all know we need to make more progress on capital markets. and exactly also at the time that finance ministers need to reduce their borrowing over time, we also need to increase investment in better jobs, in greener jobs, in a more digital future. So for all of those reasons, I'm confident that by the end of today, the finance ministers of the European Union will have endorsed a plan regarding how we can make progress on capital markets in the next Commission in the next 5 years of the European Union.
So, President, how quickly do you think it's realistic to start implementing some of the changes? And what happens if you fail to agree on it today?
I think it's very possible that we can make progress soon. There are many initiatives that are already been implemented, but what we have done is taken a step back at the bigger projects that we need to deliver, and we have invited the next Commission to bring forward initiatives in these areas. So I will be very positive and very hopeful that across 2025, many of the different ideas and initiatives that we are focusing on today, that you will see progress on them, because we need to make progress faster than we have made in recent years.
So what could be the landing zone for supervision, maybe one of the things where we could see the most tension?
So I think as we work through that particular area across the afternoon with finance ministers, my judgment is that you will see focus on how we can converge our supervisory efforts within the European Union, focus on a common rule book, but also a focus on looking at the trade-offs between regulation and competitiveness. So my expectation is that by this evening we will have reached agreement on this, with the focus on convergence and also a consideration of how supervision, what impact it has on the competitiveness of the European Union and the growth of our capital markets.
What do you think of France's suggestion to actually advance as a smaller group to make, more meaningful progress with the Capital Markets Union?
So it's up to each country to suggest ideas regarding further cooperation with other members of the European Union. And Minister Le Maire in France have advocated a number of ideas that they think they can make faster progress on in a smaller group. As President of the Eurogroup, it's my ambition and indeed my duty to find agreement amongst all ministers, and that's what we will do today. And I would see the suggestions that have been advocated by Minister Le Maire being complementary to our work as opposed to being in conflict with our work. Later today, we'll reach agreement on an overall direction with regard to capital markets. And if other countries want to do more, to be more ambitious, based on that foundation, that is up to them. And we will hear from them, I'm sure, in due course regarding how they want to make that happen.
There's a lot of discussion around, joint debt and how to ramp up, to pay for ramping up actually funding for European defense. How do you think we should go around this?
I think the first step in any of that, Francine, is being able to show that the current European Union commitment to the issuing of new debt, which is next generation EU, be able to prove to each other that that is working and that it is having the effect that we want. You're correct to say there are many different views in relation to how defence expenditure can be funded. My own judgment is that at least in the short term, this will come out of national decisions that ministers take, and the new economic governance framework, that's the new budget rules for the European Union, do give a particular recognition to defence expenditure. So overall, in the short term, it will be national decisions that ministers take. And in the medium to long term, if we are to get to the point of new instruments, we have to be able to show that our current agreement in relation to next generation EU, the new debt in relation to that, is working in the way that was intended. I'm optimistic we'll be able to show that that is the case.
How high do you put the risk of a recession in Europe, and how worried are you about Germany, given the latest set of data?
I'm confident, Francine, that if political and security factors stay the same as they are at the moment, and those particular conditions do not change, that Europe will be able to avoid a recession across this year and next. Our efforts to contain inflation are working, and we are containing inflation while keeping employment at a very high rate and still seeing growth, albeit a low level of growth in the majority of economies. So my expectation for this year is that we will have economic growth this year of probably between 0.5 and 0.8% across the euro area. And for next year, I see that growth accelerating to around 1.5%. So I believe we will avoid that recessionary risk. But those low rates of economic growth are still not what I would want them to be, and that is why our work on capital markets today is so important. We need to grow faster in the medium term, particularly as we're successful with inflation, and that is why capital markets can make a bigger contribution to that growth.
President Donoghue, when you look at the question of joint debt, if there is more joint debt, we were talking about defense, it could be for other issues. Does it strengthen the international role of the euro?
Any developments in relation to the common issuance of debt that are euro-denominated, if we can prove that there is a strong market demand for that debt, it does have a positive impact on the international role of the euro. And that in many ways has been the story of Next Generation EU. We have seen that debt that is backed up by all of the euro area, by all of the European Union, is something that there is a high level of market demand in. And it is one of a number of projects that we need to deliver to strengthen the international role of the euro. Whether it's the digital future of the euro, our work on banking union and capital markets union, and then proving that Next Generation EU is the success that I believe it is, and that I believe it will be in the years ahead. Yeah. They're all really important ingredients in strengthening the role of the euro. It's why we were delighted to welcome Croatia into the euro area, and it's also why I look forward to welcoming Bulgaria into the euro area next year as they continue with their efforts to meet the entry criteria.
Pascal Donoghue, thank you so much for joining us. That was, of course, the president of the Eurogroup, ahead of that Eurogroup meeting to talk about capital markets union and much more. Coming up, the U.S. Department of Justice opens a criminal investigation into January's mid-air panel blowout on an Alaskan Airlines flight. We'll look into the investigation and what it means for the future of Boeing. That's next, and this is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
Max fuselage panel on an Alaskan Airlines flight. The airline says this is standard practice for the DOJ and that it does not believe it's the target of the inquiry. Now, to discuss the probe and some of the other key corporate stories in the U.S., I'm joined by Bloomberg's Charlie Wells. Charlie, always good to speak to you. So what are the details that we know so far about the Justice Department's criminal investigation into this Boeing incident?
Yeah, so some of the details have started to emerge over the weekend, and basically reports said that investigators have started speaking with crew members and passengers about what happened. Now, Alaska Airlines says that, this is standard practice when an incident like this happens. They also said they don't think that they're a target of the probe. Now, this was an incident that happened with a Boeing 737 MAX plane, and we do know that Boeing declined to comment over the weekend. But what is really striking here is that Boeing has been in a deferred prosecution agreement with the government since 2021, and one of the issues is that this incident in January took place 2 days before that agreement was set to lapse. So that agreement, which was settled for $2.5 billion, could potentially be ripped up if there's an issue here.
Charlie, the other story we're watching is, of course, Reddit said to be seeking some $748 million in a forthcoming IPO.
That's huge. I mean, it's huge. I think people could potentially be looking at, something of a rebirth of the IPO market. You and I have been talking about that for a long time now. Looking back to last autumn, there was hope with ARM that this would be sort of a liftoff. I mean, look, it's 22 million shares. I think Reddit's hoping to get somewhere between $31 and $34 per share. But of course, this is difficult. They're offering some shares to super users, so that could potentially actually be a struggle because Wall Street bets, of course, on Reddit. Some people there have been saying they want to short this stock. So look, could be the growth of the new IPO market. We've seen some really good IPOs so far, but remains to be seen.
I just want the next meme. What can you tell us about Oracle?
So look, maybe some standardization here, some stabilization. So earnings per share are expected by consensus to be $1.38, up about 13% from the same period the year before. Revenue up about 7%. And look, they're really trying hard to get into this cloud infrastructure space. It is heavily competitive. They've had some issues in the past, but it looks like it's stabilizing. They're also integrating Cerner, a digital healthcare company that they acquired in 2022. It looks like that integration is going pretty well, but it's taking a little bit longer than expected. We'll get more details later today.
Okay, Oscars. So I watch the outfits. You actually watch the film. So this is why we're a great duo. Oppenheimer won big.
Yeah, and I think the takeaway here is that big was better, at least at the Oscars. So Oppenheimer, we know, not one of those indie art house films. It's from Universal. Disney also won big at the awards ceremony yesterday. And so this seems to indicate, that some of these bigger houses were, benefiting over some of the streamers like Netflix. But of course, it's not looking like the best season coming up, with some muted activity in theaters last year.
I love that you know this by heart. I mean, I just watched Ryan Gosling. That's all I know, singing I'm Enough. Charlie Wells, thank you so much. Our very own Charlie Wells with all of the data that we need to look at in the U.S. Now, surveillance is ahead for the moment. Of course, futures in the U.S. down, a pretty data-heavy week that will test the market's conviction that the Fed will move closer to dialing back their inflation fight.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
Operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
The bar for the Fed to start to cut is largely from the inflation front, just showing continued moderation.
Rate cuts are still very much in the picture. The market's pricing in the summer, and I think that's quite reasonable.
I think they've got room to be very, very patient.
It is very likely that you could see these rate cuts get pushed back. There is a cyclical recovery that's brewing in this economy, which may not support that May or June cut.
The baseline remains 2 to 3 cuts this year starting in June. Hopefully now we'll have less chatter about either a hike or no hikes this year.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
We got to stop changing the clocks. Don't you agree?
Oh, gosh.
It's like the weekend never happened. No,
Honestly,
I do. I think
there's no reason for
Monday morning, Bramo, this is what everyone is feeling. Stateside. Horrendous.
There is no reason to do daylight savings time. I looked up every reason. It has been proven to be incorrect. It doesn't have any energy savings, and the only reason why is because people want the romance of long winter, long summer vacations, long summer evenings, and barbecues. The barbecue
I knew that out of everything, this was going to be the one thing to wind you up. Not jobs, not the Fed, not markets, not CPI.
Am I that predictable? I
Changing the clocks.
last night. Well, I mean, don't you feel the same?
I feel exactly the same. Let's get your week started. Live from New York City this morning. Good morning, good morning. Equity futures negative by 0.1 on the S&P 500. Good news is apparently good news. Bad news is good news. How about no news is good news? And really last week was a no news week. The absence of blowout numbers last week, Bramo, I think that is where it's at.
It should be good news, and it was good news for the bond market. Is it good news, though, for the duration of a stock market rally that's showing some signs of maybe the leadership getting a little tired? And that's what I think people are focused on. Are some of the volatility moves that we've seen in the likes of NVIDIA kind of leading to this feeling that maybe the Magnificent Seven aren't so magnificent?
Let's get to the NVIDIA check early on. In the pre-market, we are positive by 2.2%. On Friday, this stock was all over the place. So at one point, it was positive 5%, closed lower by 5.5%. I think we were on a 6-day winning streak going into that, up by 19 percentage points on NVIDIA. Friday's session was kind of odd, given this move in this stock.
Given the fact that you had $250 billion of market valuation that you lost at the end of the day after this wild ride, understandably, it's already up dramatically, and it's up something like 80-something% so far this year. So no one's crying for NVIDIA, but it raises this question about whether this volatility means that things are topping out. And I know that everyone's saying, okay, you've called topping out many times before.
Sure.
But a lot of people are saying that notes over the weekend.
We've got a week full of economic data this week. Lisa's going to go through the calendar in just a moment. We are building on payrolls from Friday, looking ahead to CPI and retail sales. The reaction so far, AMH, from Deutsche Bank, the song remains the same. Alarian telling us on Friday it was an ambiguous jobs report. Bank of America, resilience, not re-acceleration. I think that's a key point for this Federal Reserve going into next week, and we'll catch up with BofA a little bit later.
Absolutely, and when you're looking at what the Biden administration is going to be touting, you say they have their budget report, Jonathan. This is just basically, it's not really worth the paper it's written on, given the fact that it's on policies that the president can easily enact. It's ambitions. But what I found so interesting over the weekend, when you're looking at the jobs, and also we're waiting for that inflation print, President Biden was signaling a note to the Fed. Because when he spoke at a campaign event Friday evening, he said, I can guarantee it, but I bet you betcha those rates are coming down more. That little outfit that sets interest rates, it's going to come down. He doesn't like to insert himself. He says the Fed is independent, but we saw him do this again when it was a prior jobs report last year.
Yeah, I'm not sure when the last time the Federal Reserve was referred to that little outfit that sets interest rates. The latest poll out from the Financial Times and the Ross School of Business over at the University of Michigan, I think, spelling trouble for Biden, and two things stand out. Americans' assessment of the economy, actually better since November. The approval of Biden's handling of the economy, Lisa, absolutely flatlining over the same period. So that enthusiasm for the economy that's slowly picking up, not translating into better polling for the president.
The actual numbers are kind of shocking, given the fact that his approval rating is 36% for his handling of the economy, and yet almost half of U.S. voters now say they're living comfortably or able to, quote, meet expenses with a little left over. So the inflation shock is ebbing. But the shock for Biden's ratings, not so much.
We see this continuously in polls, and we also see it in the University of Michigan survey in January. We're going to get that as well, an update this week. Americans are starting to feel a little bit better about their finances. They're starting to feel better about the overall economy, but they're not giving the credit to Biden. And this is the gap he needs to overcome, Jonathan, ahead of the November election.
Let's start this morning with some price action for you. From New York, equity futures negative by 0.15% on the S&P 500. Equities actually coming off the back of a week of losses after Friday's price action. Really muted marginal stuff, though. We were down about 0.25% on the S&P. No drama, Bramo.
I know, but
yields unchanged on a 10-year, 4.0672%. We have seen a move lower in yields, both on the 2-year and the 10-year, Lisa, through last week.
And that's really the key question, is whether you're going to see that continue this week, when you could potentially get an upside surprise. When you get CPI tomorrow, PPI on Thursday, as well as retail sales, initial jobless claims. And of course, on Friday, we do get University of Michigan sentiment survey. But to me, the real question is going to be how much oil prices are going to really influence PPI. And then, of course, on the heels of all of that, just in case you were wondering, there are a host of auctions, bond auctions, at a time where perhaps some of these yields gotten too low. Barclays is saying short the 10-year. We've got 3-year notes being auctioned today. We've got 10-year notes being auctioned tomorrow. And we have $22 billion of 30-year bonds auctioned off on Wednesday.
Tons of supply coming through the week. Just to bring you the estimates of that CPI print, 0.3% month over month, stripping out food and energy compared to the previous month of 0.4. Coming up this hour, Jeff Yu of BNY Mellon looking ahead to this week's inflation data. Terry Haynes of Pangea Policy as Biden warns Israel not to invade Rafah, and Andrew Honhorst of Citi on the Fed's path forward. We begin this morning with our top story. A big week ahead for global markets going into next week's Fed decision. Investors eyeing tomorrow's CPI report and retail sales just a few days later. Jeff Yu of BNY Mellon writing, quote, our call for a March cut and then another in May will probably prove too dovish. And we acknowledge that. It's June meeting that will likely offer the FOMC its first chance to reduce the federal funds rate. Jeff, I'm pleased to say, joins us right now for more. Jeff, great to catch up with you, sir. Chairman Powell says he needs a little bit more evidence. Is that one inflation print, two inflation prints, or three?
I think he's going to keep that quite close to his chest, but probably at least two more at that point. We need not just to hit expectations, but potentially to surprise them to the downside a bit. And as stated, we probably started the year a bit too dovish and expecting these downside surprises to come off earlier than expected. But let's make it clear, still we will get cuts this year. This recent talk about no landing, no cuts, we think the market is going to start pricing that out at the very least.
Just probably no cuts next week, Jeff, but we will get a new set of outlook in the summary of economic projections. All the policymakers are going to put in where they think Fed rates will be, GDP, growth, unemployment, all of that bad stuff, CPI. Jeff, when you plug in those expectations next week, will they look any different to where they were back in December?
I don't think they will be that different. It's really about the guidance, and I think Powell and all the most of the other FOMC members, what they need to do is, not what several ECB hawks are saying is we need to confirm, the data needs to confirm we get to 2% or lower before we can cut rates, because I think that is the definition of getting behind the curve. You need to get ahead of disinflation, leave everything on the table. So this means from Q2 onwards, every meeting will be a live meeting. Let's make that clear as well.
Okay, Jeff, a lot of people, perhaps you can take the no rate cut people out of the equation because you started by saying they're being a little ridiculous. But moving forward, it does seem like there are fewer rate cuts being priced into the U.S. than Europe. And I don't understand why the euro has remained so resilient and the dollar hasn't strengthened even more considering the economic data and the rate cut outlook. What's your take?
I totally agree, and I think markets are just whether it's a positioning issue and just worried that the market is still overextended itself in terms of dollar holdings. But I think there will be a point of reckoning, with the ECB acknowledging that the European economy faces severe issues with regard to manufacturing demand. If I just strip the demand in the eurozone, looking at imports, for example, whether you look at the material side of things or the consumer goods versus manufacturing goods, it's all contracting, double-digit contraction. So that is extremely worrying. And I think the ECB, especially the hawkish elements, need to get on board with that and at the very least acknowledge the euro is totally misaligned with where the economy is right now.
So what would be more aligned, Jeff?
Well, I'm still holding on to my view that at some point this year, we're going to get parity in euro-dollar. There will be that point where there will be a total revision of their expectations for rate cuts. And if you compare it with the Fed, for example, sure, the Fed may start cutting a bit later, but the pace will be moderate, maybe one per quarter. But we're going to be looking at consecutive 25 basis point moves, at least 100, if not 125 basis points for the ECB for the rest of the year. And I think that's when the gaps are really going to start to open up and
Jeff,
drive euro lower as well.
To some degree, we have started to price this in fixed income. Yet to Lisa's point, we haven't seen it push through the FX market in a strong way, in a way maybe that you would expect, Jeff. And I guess Lisa's asking, why hasn't that happened?
So I would go back to the dollar positioning view. I go back to my market positioning as a barbell approach. On the cash side, US real rates and nominal rates relatively high. So for your risk-free assets, you own the dollar. For your risk-on assets, you own US equities. There's nothing in between, and people are worried about that. So as a hedge almost against that over-positioning in the US, you want to own some euros, but at this point, it is the wrong currency. It's the wrong asset to own. Given what's going on with the BOJ, with Japan right now, maybe it's time to start looking further east and maybe look at Asia again.
All right, talking about what's going on with Bank of Japan, we can't let that lie because we did see that the recession that was almost priced in was priced out, with the GDP coming in and revised at a positive 0.4% over in Japan. Do you think that basically this is basically a verdict on negative rate policies, that they're going to successfully be able to exit later this month, and that March really is the time for the Bank of Japan?
Well, March is certainly a live meeting, and I think they're looking at the GDP data, and also they are looking at the underlying data in terms of wages. We know it's been the spring wage round, and they're definitely collecting all the intel from Japanese companies and seeing upside surprises to internal company wage settlements, and they know they need to act. They need to flip expectations at the very least. Now, the challenge to the market right now is we've priced about 4 big figures lower in dollar yen, from 150 down to 146. Is there scope for more? I have a feeling the market's still positioned to, okay, buy the rumor, sell the fact, and then see whether the BOJ can to surprise to the hawkish side. The bar has just been raised for that. There's no longer the surprise element, but let's not rule that out either heading into the March meeting.
Jeff, I'm wondering if the challenge for the market is actually in Japanese equities off the back of what you think might happen on dollar yen. We've just had a 5th fifth straight day of yen strength. And in the Nikkei 225, one of the worst days so far this year. Jeff, what's the relationship going to be? I think so far this year, we've learned that you don't need a ton of yen weakness to get the Nikkei 225 to appreciate. What I'm trying to figure out is what happens if you get a severe bout of yen strength, a move down from 150 to 140, 130, 120, I don't know. But a lot of people are lining up to be long Japanese equities over the last 6 months, and I think they're all asking the same question. What happens?
Well, where is dollar yen fair value, right? And if you look at the hedging levels for Japanese auto manufacturers from way gone by, they were looking at between 100 and 110, right? So, which means for Japanese industry as a whole, at those levels, they probably can still remain profitable. What are the hedge ratios, for example? But basically, my rule of thumb would be you have a number in mind, and because of the internal hedging strategies, you have to go below those fair value numbers before the earnings really start to become, the yen becomes a headwind to earnings. So I really wouldn't worry about earnings translation with yen, at least for the next 20 big figures.
Profits will be good, Jeff, but what will international investors be willing to pay for them? That's what I'm trying to figure out. How reactive will they be to seeing a Japanese yen appreciate in the fashion that maybe we should be anticipating?
Right, so there it's about pace as much as levels. If you told the earnings estimates that we're going to be at 130 by next quarter, then that's talking a serious adjustment. But if it's going to be a gradual move convergence to fair value over the course of, say, 12 to 18 months, more in line with where, let's say, implied volatility is hinting at right now, I think that can be absorbed quite easily. So manage the pace rather than the level.
Jeff Yu of BNY Mellon. Jeff, thank you. A lot of people, favorite region, Bramo, outside the United States, it's Japan. Japanese equities pulling back a little bit today, but still up on the year by 16%.
It's such a complicated question, and it's such a good question about what happens if they do exit their negative rate policies, what that does to equities. Because on one hand, you would think that this actually draws more capital into Japan, which might be a positive. On the other hand, it's a real problem if you want a discount, and a discounted purchase was essentially what people were doing. The other aspect is the Bank of Japan and their balance sheet. What happens to the ETFs they've been purchasing and all of the other types of stimulus?
Massive influence, not just in the bond market, over the BOJ, in stocks as well. Equity futures right now on the S&P, negative by 0.16% on the S&P 500. Up next on this program, Biden's red line for Netanyahu.
The defense of Israel is still critical, so there's no red line, I'm going to cut off all weapons. But there's red lines that if he crosses them, you cannot have 30,000 more Palestinians dead.
That conversation coming up next, live from New York City this morning. Good morning.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Live from New York City this morning. Good morning to you all. Equity futures on the S&P 500 pulling back this morning after a week of losses last week. We're down about 0.2% on the S&P. Yields basically unchanged on a 10-year, 4.07%. And in the FX market, going absolutely nowhere. The euro against the dollar, 109.38. Under Savannah's this morning, Biden's red line for Netanyahu.
The defense of Israel is still critical, so there's no red line. I'm going to cut off all weapons so they don't have the Iron Dome to protect them. They don't have, but there's red lines that if he crosses and he cannot have 30,000 more Palestinians dead as a consequence of going after. There's other ways to deal with the trauma caused by Hamas.
Here's the latest this morning. President Biden warning Israel against an attack on the Gaza city of Rafah. Ceasefire talks with Hamas remain deadlocked as Muslims enter the holy month of Ramadan. Terry Haynes of Pangea Policy joins us now for more. Terry, wonderful to have you with us this Monday morning. I'm trying to work out if there's a real division between these two leaders or if this is just a convenient media narrative for the president given the domestic politics here in the U.S.
I'm with the second, John. I think what you have here is a situation where the president's doing his best to operate a straddle, it's not. In the end, it's not really pleasing anybody, first. And secondly, I think I'd look at it from the Israelis' point of view as well. The president's foreign policy abroad, even with allies, is not being greeted as a paragon of strength or consistency, going back to the Afghanistan withdrawal. And, so there's this fiction being generated in the United States that the United States can have a hand in the Israeli response, and that's been proven false over the last 150 days. So I think what you got here with the president is a much more political line here than anything else.
Well, this time last week, Biden was hopeful we would have seen a ceasefire. We are now into the holy month of Ramadan. How much strain is not having a ceasefire going to cause within his Democratic base?
It'll cause a continued strain throughout, and since this war is not going to end quickly, and the problems caused by it are not going to go away quickly as a result of it, there will be a continued strain. And I'd remind markets as well that the president's predictive powers, whether it be on ceasefires or rate cuts or a lot of other things, hasn't been really good recently. I think a lot of this stuff is aspirational, and because it's aspirational and hopeful, I think people should not be taking it to the bank.
We started off the show talking about Biden's poll numbers, Terry, and today he's going to have a lot of campaign speak when he releases his budget. But the polling numbers show that people are starting to feel better about their personal finances and the economy, but are not giving Biden the credit. Does the timeline help him? Is it on his side ahead of November?
Oh, sure. The good news here is Biden's got 8 more months before the election. The bad news is that the rest of us have 8 more months before the election. So, but what you've got is a narrative with time to adhere and time to sink in. So, yeah, I think that on balance, that is good news for him.
You write in your note today, doesn't mean anything when it comes to the budget. Are you prepared to learn anything when he releases this budget?
I'm prepared to learn what his political priorities are, and that's about it. One other thing that I'd said in the note yesterday was, if you don't believe me that the budget doesn't matter, look at our current wrangling around about spending bills. What matters is appropriations. What matters is spending bills. The budget is meant to be a broad top-line aspirational goal to try to figure out what spending should be. But in the end, nobody's ever going to be able to tell you in Washington. I mean, there are a few always who can do this, but nobody else really can. What the relationship is between a budget priority and what's actually happening on the ground on spending. Defense is a perfect example of that. Biden's, according to press reports, will say he wants to increase defense spending 1%. He said something similar last year, and Congress essentially bigfooted him and raised defense more than Biden wanted it. Same thing will happen this year.
That's the reason why a lot of people are looking beyond the budget. A lot of people are not paying attention to it, just like yourself. And they're paying attention to things like the potential TikTok ban that has been proposed. President Biden says that he will sign it, and yet Bloomberg Intelligence thinks that the Republican administration or a Republican administration would be more likely to ban it than the current one. Do you agree?
No, I don't agree with respect to your folks. I think what matters here the most is how the goal gets done. You know, when you've got bipartisan agreement in Congress with a 50-0 vote in a committee, and more importantly, you've had Senate Intel Chair Mark Warner, who's very respected, and nobody's countermanding him on this, saying TikTok itself is a national security threat. What you've got here is a world in which something has to be done sooner rather than later. And I remember you and I talking about this at this time last year, and I think the pressures to do something before the election, frankly, are going to be overwhelming. And TikTok hasn't covered itself in glory. They continue to make this thing worse on themselves.
Terry, the former president's got form. He can blow up deals before they happen. He's against this for some reason. And Terry, maybe you can explain that. Does he have the potential, the power to blow this up too?
He has some potential to do it. I think, today I would say that the better half of the argument is the national security issues. But, the president's not going to cover himself in glory on this. And what you've got is a situation also where the interesting part about this is you've got not only the former president involved in this, you've also got major Republican Party backers like the Club for Growth involved, and some of its major backers involved. There's a little bit of a feedback loop here that has the potential to embarrass a lot of people if for some reason Republicans in Congress take the view that they shouldn't be doing something about TikTok.
If it passes in the House, do you see Senator Schumer putting it on the floor in the Senate?
Yeah, I think he'll probably have to do something, but the first thing he'll do is engage in negotiations and probably appoint Senator Warner of Virginia to do this, engage in negotiations to try to find a bipartisan solution. One thing that Senator Warner has said, for example, is he's all for banning TikTok, but at the same time focusing on a single app he thinks may present some constitutional problems. So the question of how is going to take over in the Senate before actually putting it on the floor, I think.
Terry, what we really want to know is not about TikTok. It's not about the election. It's about when are they going to ban daylight savings time? Why have they not taken it away, given the fact that everyone hates it? Why?
I know my limits, and this is definitely one of them. It's inexplicable, isn't it? But I do enjoy the dark.
Terry, thank you, sir. I don't share that view. Terry Haynes of Pangea Policy, thank you, sir, down in Washington, D.C. You can see what Bramo's fired up about today. Let's talk about TikTok just briefly. Look, there's two issues here. One is about the control and ownership of U.S. data. The second is basically rotting the minds of American children worldwide. And there is this, I guess, pushback that if we're not solving everything, we shouldn't do anything on Capitol Hill. And that's some pushback, AMH, that I think a lot of people don't share.
Well, I think what was astonishing was Trump's reversal on this, coming out on Truth, saying he's not so sure. It comes at a time when after he met with the Club for Growth group, Jeff Yass is a huge donor on the sidelines for Trump at the moment. If he gets involved, is that why potentially President Trump is now saying, I'm not so quite sure about TikTok? He has a more than $30 billion stake in the company.
I think we've all forgotten what happened in the summer of 2020. Just totally forgot about it, that there was a deal struck between ByteDance and Oracle and Walmart back in the summer of 2020. And then, Bramo, it just disappeared. No one talked about it in the months afterwards. The president left the White House, Biden came in and didn't come back up again.
You reminded me about that this morning because Oracle is reporting earnings after the bell. I hadn't even remembered it. And I went back and looked at it and thought, yeah, why is that no one talked about that? There was a deal. Who pushed back? What happened here? What's the anatomy of the failure? You talk about, the two things, both national security and the rotting of the minds. There are a lot of things that rot the minds of our children. I can attest to that personally. If they really have national security concerns, though, that's something that they should emphasize and they can't really ignore if that's really their main concern.
And if this is all about funding and lobbying, then that's just another reason to be despised by what happens down in Washington, D.C.
Well, and if it's about people wanting to, cater to the youth vote, that's the other thing. I mean, how do you cater to the youth vote?
It's slightly odd, isn't it, that the president sits there and says, if they pass it, I'll sign it, as his campaign gets TikTok ready.
Yeah. How do you feel
about
this?
I think everyone knows. Equity futures on the S&P 500 down by 0.25%. Up next, we'll look at some data out of China and why the biggest data point of the week might not be CPI Tuesday, and it might actually be coming in Friday in a different country.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Pulling back from all-time highs in Friday's session, starting the week just south of those levels. We're negative by 1/4% on the S&P. We're down 1/4% on the Nasdaq 100 as well. Wild session Friday for Nvidia. Nvidia this morning just about positive in the pre-market after closing Friday down by 5.5%. We're positive by a little more than 1 full percentage point. That's the equity market story. Here's the bond market picture for you. 2-year, 10-year, 30-year. Let's sit on the 2-year, up a basis point, 448.79 on a 2-year yield. Instead of reinforcing the strength of the January data, I think the payrolls report just introducing an even bigger question mark, Lisa, over it and unlocking some enthusiasm to buy bonds again and driving yields lower through the week.
Downward revisions. A lot of people are focused on that. The fact that the wage increase was lower than expected. The unemployment rate rose to 3.9%. And then you have the likes of Michael Reed of RBC saying fade the, quote, weakness, because guess where the rise in unemployment came from? 16 and 19-year-olds who are no longer getting jobs. So at a certain point, who are we talking about here? And starting to look beneath the hood. North of 200,000 jobs being created, really weak. The debate will continue.
Speaking of fading the weakness, wasn't it Barclays this morning who was saying maybe fade some of the move in the bond market as well? We've had a 20 to 30 basis point move lower in yields across the curve.
I saw that, and I think about how many people are probably going to join that, given the fact that there still is this risk with CPI, and frankly, there still is quite a bit of strength. You're not seeing some sort of huge wave of layoffs or any kind of real sign of weakness. It just isn't as hot as it could have been, and that was enough for the market last week.
Let's turn to foreign exchange. I want to look at dollar yen at 146.65, negative on this currency pair for a 5th straight session, so that's yen strength. I said before the commercial break, biggest data point of the week, maybe not stateside, perhaps not CPI. Maybe you'll find it in Japan. On Friday, the largest union announcing wage negotiation results as a data point, Lisa, informing central bank decisions. That might be it for the week, the number one.
100%, especially because a lot of other unions have already negotiated wage increases that are the most going back to 2011 or even more. This is the question. How much does it push them to raise rates? And not only that, but do they push it more positive, right? So it's not just to zero, but also straight to 0.25%.
The start of a cycle, the first hike since 07. Unbelievable stuff. Another morning of yen strength. Under surveillance this morning, our top stories. Investors keeping a close eye on data this week, looking for clues about when the Fed might start cutting interest rates. Following Friday's mixed payrolls report, February CPI due out tomorrow, and PPI and retail sales on Thursday. The Fed meeting next week and is widely expected to hold interest rates steady for its 5th consecutive meeting. Next week is all about the outlook, the summary of economic projections, and most of the reading I've done over the weekend, Lisa, suggesting they're going to be basically unchanged relative to what we saw in December.
The round trip has happened in the market. It hasn't happened with respect to the Fed's expectations, and frankly, the market has come to what the Fed has said. Stuart Kaiser put it really well of Citigroup. He came out and said CPI is now priced as the largest risk event in March, that this is entirely going to be a Federal Reserve dependent on the March 12 CPI, and if it comes in hotter than expected, expects more doubt raised about how quickly they can cut rates.
Bloomberg Intelligence looked at the gasoline prices for a reason why we could see a slight uptick to the prior month. I have to say that would be incredibly interesting because gasoline prices have been on the side of this administration this year going into an election, and it's been the jewel really of lower inflation prints, the fact that gasoline prices have been so low.
I mentioned some of the estimates a little bit earlier this morning, just to share them with you again if you are just tuning in. CPI tomorrow, strip out food and energy, month over month we're looking for 0.3%. The previous month, 0.4. Let's turn to our next story. President Biden taking on TikTok. Biden saying he'll support a quickly moving bipartisan bill that could ban the social media app if Congress passes it. The bill would require TikTok parent ByteDance to divest it or face a ban on U.S. app stores. The bill cites national security concerns. TikTok has pushed back on those allegations. Everywhere you look in Washington, you will always find contradictions, which is why I think we all get driven nuts by politicians week after week, week after week. And this one is just a massive contradiction. See the president say, if you pass it, I'll sign it, and at the same time, you've got a campaign as you run to be the president of the United States, campaigning on TikTok simultaneously.
Well, Senator Warner was on Face the Nation this weekend. He said he's uncomfortable with that mixed message. He said it is a mixed message. But the president also knows that this needs to get through the House, needs to get through the Senate. Of course, the government is not using it. The White House is not using it. But they feel that they need to go out and get that youth vote that helped him in 2020. And to reach the youth, they have to go to TikTok.
What happened with Oracle? I mean, seriously, like, I want to understand the anatomy of this concern, which has been prevalent for a long time. Why does it die and get regurgitated every couple of months?
Everyone should go back to the stories of summer 2020. I think the deadline was the middle of September, something like September 15th. And this all started in August of that year. And I remember it wasn't just that the deal went to, say, Oracle and Walmart. It was also that there was this specified amount of money that you had to give to Treasury to get the deal. It was almost like a commission fee for President Donald Trump in the White House. It was truly bizarre. I think the number was about $5 billion. And it was going to the Treasury, wasn't it, AMH, to help education or something like that. It was such a bizarre period. What was weird about it is we just kind of moved on from it really quickly and stopped talking about it.
Well, in the end, Trump just said he's going to ban it, and then it was held up in courts. Biden administration came in. They said, okay, this is being held up in courts. We're going to do our own review of it, and now it has been sitting in a CFIUS review, while hardliners in Congress said they want to take up a bill that would give the president the authority, without having to deal with potentially some of this legal pushback, to actually ban it, and that's where we are today.
I'm not sure what I think about the former president's business model that he was setting up for the White House, that the White House could just break up companies and then charge a commission to American companies that could buy them. It's kind of bizarre, wasn't it? It was weird then. It's weird to think about now.
Yeah, well, we get to talk about it again.
Yeah, we do, and maybe sometime soon. A slew of data out of China, CPI rising for the first time since August, increasing 0.7% from a year ago. PPI falling 2.7%, continuing the longest string of declines since 2016. This is the annual National People's Congress comes to a close in Beijing. And Karen joins us now from DC. One of my favorite quotes coming off the back of this get-together, the annual get-together, and it came from Natixis. They said it was a target without a plan, a growth target without a plan. Do they have a plan?
I mean, obviously they have a plan, but there's skepticism about whether or not they will meet what they want this year, John, which is the growth target of about 5%. And in fact, even inflation is meant to come in at 3% according to the objective targets. But as you mentioned, those numbers over the weekend did show a pickup in inflation last month, but that's actually being put down to the Lunar New Year holiday period. That was because people traveled more, spent more on food. Tourism prices actually rose by 23%. There was a bad weather effect, and there was a base effect there as well. So, you know, inflation is expected to is expected to pull out of deflation this year. But as you mentioned, it's going to be a lot of work to hit these key targets: the growth target, the inflation target, to keep within their boring strategy that they've laid out without the need to support the rest of the economy. There's still, I think, a lot of pressure and a lot of question marks around whether or not Beijing can turn the economy around this year, and that remains very much, I think, an open book for foreign investors.
There also are questions around what exactly is the state of the Chinese economy right now, because we do see consumer spending picking up when it comes to certain things like restaurants or even travel, and yet iron ore is falling the most since 2022 today. It's the lowest since August, and we've seen the stockpiles really increase dramatically in China.
There's no doubt iron ore is a fascinating one to watch. It's always been the 101 proxy for where China's economy is headed. I think it surprised most people last year that it held up as high as it did, despite the mood music on China's economy. We also had language over the weekend repeating the point that houses are for living in, not for speculating. That doesn't lend itself towards the idea of rapid surgery to turn the housing market around. I think, as we were saying, Lisa, there are still significant question marks around where China's economy is going to go this year. They have set a growth target of 5%. That's very aggressive because they don't have a favourable base effect, and the boring targets they've set out do suggest an increase in stimulus, but it's still got a long way to go. Consumer sentiment is somewhat mixed, but I think most people would agree it's certainly not where it could be, not what it was back in the roaring decade that we just left. I think we'll have to keep an eye on, above all else, the housing market, see what kind of intervention the authorities do there, when and if they can turn that around. And when and if that turns around, that will drive the rest of the China economy story, including iron ore prices.
You know, I'm still struck by what Leland Miller of the China Beige Book said, where maybe Xi Jinping doesn't care if he doesn't hit his 5% target, that maybe he doesn't care if there isn't more strength because their goals right now are elsewhere other than just supporting the economy. Do you agree with that, that essentially it's no longer a priority to keep the economy really roaring, and that now it's about making more products in China and instating some other of Xi Jinping's goals?
I mean, some of it, you can look at it both ways. There's no doubt that they want more sustainable growth. They are not advocating the go-go years that we all became used to of rapid growth in China at any cost. That's gone. They want sustainable growth. And within that, Lisa, you're absolutely right. They're talking a lot now about innovation, technology, high-quality growth, I think was one of the phrases that came out of the NPC or is being used a lot more recently. But at the same time, though, if they set a growth target of 5%, the authorities in Beijing will want to hit that, or they'll want to come pretty close. It's not like they totally will walk away from it, barring some kind of emergency, which we saw during the pandemic, for example. So I think both can be correct. They do have top priorities there. You'd have to say security, technological development, of course, and innovation is probably number one on the list. But at the same time, growing the economy and ensuring that consumption and wealth is increasing is also very important. And that's why I think there's still an expectation that the government will come pretty close to hitting the 5% target when it's all added up at the end of the year.
The Chinese legislator today voted to change a 4-decade-old law, really tightens the grip in China for things like she thought. Does that have any impact, Enda, on the economy?
Well, so again, this is an outside-looking in view. A lot of people say, Anne-Marie, that how really can you have an economy prosper and thrive when you have this level of party control, this level of doctrinaire control on all aspects of how decisions are made, how companies operate, how people invest. So this is a source of criticism. You've heard business people make the point that China flourished when the party kind of stepped back, so to speak, in those years and allowed innovation and technology and homegrown technology to get off the ground. And now, of course, the party's intervening in everything. The party at the center of everything, I think, is one of the lines. But this goes to the idea that China's economy is now putting national security front and center. They want to spur innovation, technology. They want to get the key parts of the economy that's in national interest in place because they're in a strategic race now with the US. So of course, there's criticism of the role the party is playing. China pushes back to say they've got their own strategic and national interests to pursue, and that's what they're doing now.
What we've seen over this meeting is there's been no press conference, and we've seen China and Xi Jinping take a tighter grip on the government. What kind of message is this going to send, Enda, to foreign investors?
I think the press conference definitely was a negative look for foreign investors. Wang Yi, the foreign minister, did give his press conference, of course, but there's no doubt that the highlight of the embassy every year was when the premier came out to speak to reporters, but not only that, to speak to the world and add some colour onto what the economic policy was for the year ahead. Of course, it was somewhat of a controlled press conference, but nonetheless, it was one of the few opportunities to question one of the top leaders of China. And when they pulled back from doing that, in the context of everything else that we've seen over the past few years, not least those raids on foreign business, and as you mentioned, the ongoing control of the party in business and in the economy, given the context that foreign investor sentiment in China is already so low, it certainly doesn't help that. I think it adds to the skepticism. And as we see with portfolio flows and as we see with declining FDI, I think the foreign world remains to be convinced as to the trajectory of China's economy at the moment.
Enda, thank you, sir. Enda Curran down in Washington, D.C. started this out by talking about no news being good news stateside. I think no news in China, at least a bad news. Looking at the headlines we saw again this morning in the commodity market.
Everyone was looking for stimulus. They've been waiting for the bazooka to come in. It hasn't happened. They've talked about maybe doing some additional stimulus around the margins, and now people basically are saying, show us the money. Otherwise, forget it.
Big time. That big red headline across the Bloomberg, iron ore getting hit. and getting hit hard. That's the story in China. Let's get you an update on stories elsewhere this morning. Let's get to your Bloomberg brief. Our first story, Reddit and its investors are seeking to raise as much as $250 million in what would be one of the biggest IPOs so far this year. The company plans to offer 22 million shares in the IPO, priced between $31 and $34 each, according to a filing with the SEC. Reddit is seeking a listing on the New York Stock Exchange under the ticker RDDT. Elsewhere, more trouble for Boeing. Delta says it expects deliveries of its Boeing 737 MAX 10 aircraft could be pushed out to as late as 2027 as the plane maker undergoes more federal safety and criminal reviews. Delta's CEO said yesterday it had expected to begin receiving the aircraft as soon as next year, but is now anticipating the delays. The airline has orders for 100 MAX 10 planes and options to purchase 30 more. And finally, Oppenheimer has picked up a total of 7 Academy Awards, including Best Picture and Best Director for Christopher Nolan. Barbie's 8 nominations amounted to just 1 trophy for the Best Song in a night that saw Hollywood's old guard return to glory amid disappointment for streaming companies. Disney's Poor Things won 4 awards, including Best Actress for Emma Stone, beating Lily Gladstone, who was in line to become the first Native American to win an Oscar for her role in Apple's Killers of the Flower Moon. Oppenheimer just absolutely crushing it. Ramo, and deservedly so. Just a fantastic movie.
That's what I was going to say. It's a great movie, and frankly, one that could be watched again and again to really pair this question of, if you can build it, should you, at a moment where the world potentially is going to deal with the consequences for a long time.
Do you want the Pharaoh movie review of the weekend? Dune 2 is actually pretty decent.
What wasn't it? Tunnels?
It was better than Dune 1. I can tell you more a little bit later.
Dune 1?
Converted.
Really?
I got through most of Dune 1 before walking out of the cinema before it finished. Dune 2 was worth a watch.
Worm tunnels, you enjoy them now?
They can ride worms now, apparently. Spoiler. Up next on the program, the case against data dependency.
Do we want to really drive a car looking at the rearview mirror with a map that may be completely revised? Of course not, right? But that's the problem with being overly data dependent.
That conversation coming up next.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Live from New York City, stocks a little softer. We're down by 0.1% on the S&P 500. Quick snapshot of the bond market for you, unchanged on a 10-year yield, 4.0788%. Under Savannah's this morning, the case against data dependency.
you have two issues with excessive data dependency. One is that data gets revised, and two, for the Fed, it has tools that operate with a lag. So do we want to really drive a car, look in the rearview mirror with a map that may be completely revised? Of course not, right? But that's the problem with being overly data dependent. Without that strategic view, that data will take you on a roller coaster and you'll get sick on it.
Fantastic line from Mohammed Al-Arian. Here's the latest this morning. Traders boosting bets on a June rate cut after the February payrolls report, with more data on deck. CPI due tomorrow, followed by retail sales and PPI on Thursday. Andrew Hoddenhorst of Citi writing this: the lower year-on-year inflation readings should keep Fed officials on track to begin cutting rates in June. A cut in May is possible, but probably only if core CPI comes in weaker than expected or activity data weakens more than we expect. Andrew Hoddenhorst joins us now for more. Andrew, good morning to you.
Good morning.
I want to pick up on Mohammed's line because I think this is really important. How dependable is the economic data when they say they are dependent on all of it?
Yeah, I think we're on that roller coaster that he was talking about. We had 275,000 new jobs. It's a strong jobs number for the month of February. But then you look back and you had 167,000 jobs that we thought were there that are no longer there. So I think that is exactly an example of the problem of tying yourself too closely to the data.
I'm going to paraphrase your work over the weekend. Solid today, recession tomorrow. What is it about now that inspires a little bit of confidence, but ultimately also informs this idea that we're going to roll over pretty soon?
So if you go back to that jobs report, I think that's a good example. 275,000 jobs, 3.9% unemployment rate. There's no way you can look at that and not say that's not a strong jobs market. It is. The issue is the trends that you're seeing, and that's what we really do as economists, is try to look at the trend and figure out where that trend is going. Data have been mixed, which I think shows that we're going into this kind of a transition period. That 3.9% unemployment rate is low, but it's up 0.4 percentage points off the low. And when you start to have this slowing in the job market, what we've seen historically is it's very hard for that not to develop into a more significant slowdown. So that's what keeps us thinking that this will weaken further later this year.
What's the Fed's role in this, especially because you've been out front saying that there's actually more strength in the data in the first half of the year than people are expecting, and then that's going to force the Fed to cut more aggressively later in the year. Do you think that by not cutting rates this month, the Fed is going to essentially carry forward some of the weaker growth that you expect later in the year?
Well, I think we're in a scenario that we haven't really experienced in decades, in a sense, in that we have inflation that's running above target, and we will have this emerging weakness in the activity data. So then you really have to ask the difficult question of, are you responding to the inflation mandate? Are you responding to the employment mandate? So I don't know that there's a right or a wrong answer for the Fed here. I do think that they're seeing enough in those inflation readings that will get them to a cut in June.
Your compatriot, Stuart Kaiser, talking about CPI is going to be an incredibly important figure for them to look at. Some people expecting it to be hotter than expected, to what Anne-Marie was talking about, the fact that you have seen gasoline prices increasing pretty significantly. How much do you think that would really color their view?
Yeah, I think what's really going to matter for the Fed here is the core. I'm interested in those gasoline prices also. I think it's interesting as we've seen consumers that are more positive on the economy. Part of that probably is gasoline prices that have come down, so let's watch that on the gasoline side. On the inflation report itself and what it means for the Fed, we're projecting 0.33% month-on-month core CPI inflation, and that's following 0.39% month-on-month core CPI inflation. And those are somewhat uncomfortable readings if what you're telling the American public is that we're coming back to 2% inflation, because it's just not 2% inflation. Now, if you look at year-on-year core PCE inflation, that was running up above 3%. It's going to keep coming down just the way the base effects work. That should be running more like 2.5% around the summer. So I think that does keep them on track to cut rates. But have we really defeated inflation? That's not clear.
You say a cut in May is possible. What would you need to see?
I think there are a couple ways you could get there. One would be just that this core inflation report, instead of coming in at a 0.33, let's say it comes in at 0.20. Maybe some of the strength that we saw in shelter prices, that turns out to be a one-off, and we really slow down in this month's print. That would at least put May more solidly on the table. And then you probably also need some kind of wobble in the activity data. With 275,000 payrolls, we think retail sales is going to be strong this week. Let's say retail sales is weaker, we have a softer inflation report, then I think we'll start start pricing that May cut again, and that could become a reality.
If rate hikes didn't slow things down, why will rate cuts help things pick up in the face of adverse data? I asked that because Governor Waller basically said, what's the rush? And President Kashkari said, why do anything? Does any of that resonate with you?
Yeah, I mean, I think that's kind of getting at this notion of where is the neutral rate of interest? Where do we have policy rates relative to what would be a neutral rate of interest? And I think it's just really hard to assess in this environment because we had incredible fiscal stimulus that came into the economy. So it could be that interest rates had the slowing effect on the economy, if you will, but it was offset by the fiscal effect of stimulus. So how do you disentangle those two? Well, we do know it very clearly is in the housing market. If you raise interest rates, you slow down the housing market. If you lower interest rates, you speed up the housing market. So that's what I would be really looking for in terms of a beta or a sensitivity to interest rates.
But to John's point, there's a question about urgency, right? I mean, if we haven't seen the kind of immediate effects, what would it matter if they cut 25 basis points now or in June or even in October?
Yeah, it goes back to Mohamed El-Erian's point, which is that you want to have a strategy and a framework for how you're pursuing these rate cuts or interest rate policy in general. What the economy will respond to is not the overnight policy rate. There's very little economic activity that's tied to that. What the economy is tied to is where is the 10-year Treasury rate? Where do individuals borrow for a 30-year mortgage? Where do corporates borrow for a 5-year corporate bond? That's what you're really controlling, and that's going to be dependent on where do markets think you're going over time. And that is what is spelled out by your reaction function, by your strategy. And so this whole discussion of, do you cut in May? Do you cut in June? Do you cut in July? The timing of that rate cut, I think Fed officials are right. It doesn't really matter what specific meeting you cut.
Just got a great question from a Bloomberg subscriber on the terminal, just pop up on the screen. It's related to markets, but equity markets. Maybe some more speculative-like assets elsewhere in financial markets. Is the Fed going to be concerned about that? They start to cut interest rates and they carry on ripping. Are we at the point where this becomes a financial stability concern? Are we anywhere near those kind of concerns?
I think it's something that they should be thinking about. Ultimately, it's overall financial conditions that are going to feed into the economy. And when you see various assets, especially some of the riskier assets that are at all-time highs, I think that should be an indication that there is a loosening of financial conditions, a very significant loosening of financial conditions that's happened since that October-November period. Remember, we were talking about lower equity prices, higher Treasury yields. This is something that the Fed partially has engineered through their policy. So absolutely, it should be an input into policy.
Lisa, stocks have absolutely ripped since the end of October and haven't stopped ripping.
And you talk about the IPOs, Reddit coming to market. I mean, it's sort of the key poster child for a period of where Bitcoin is surging to record highs. At what point does this matter? At a time when some people are saying this is actually easing financial conditions and pushing the Fed further away from their target, they don't seem to care.
Torsten Slok of Apollo said it last week on this program. In fact, he asked the question, are they really going to reduce interest rates with equities at all-time highs and credit spreads incredibly tight? We'll see. Andrew, thank you. It's good to see you.
Thank you.
Andrew Honhorst of Citi going into that data later this week. CPI tomorrow. After that, a couple of days later, we'll get retail sales, PPI, and jobless claims. Coming up in the next hour on this program, Seema Shah of Principal Asset Management, Henrietta Trays of Vader Partners, Krishna Mamani of Lafayette College joining us as well on a Monday morning with equity futures negative by, let's call it 0.1% on the S&P 500, following last week's very mild marginal pullback on a weekly basis on the S&P. From New York City, this is Bloomberg.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? the whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world, and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
The economy is humming along.
There's not a lot of reason with growth to cut rates.
You'll have more of the same. Stronger growth, slower inflation. Where good news is good news, bad news is probably still good news because it probably accelerates the number of rate cuts that we're going to get.
Right now, we're very much in a soft landing.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Your equity market basically unchanged on the S&P 500 like it was last week. Last week down about 0.25%. This morning negative by 0.1. A massive week for data this week, informing Federal Reserve decisions of next week and maybe even beyond. CPI, Bramo, just around the corner. Then look to retail sales and jobless claims.
Given the fact that we already got a job number that really was hotter than expected, at least in the headline level, but revised lower, the question now is, does this come with inflation or not? Ultimately, Stuart Kaiser saying this is going to be the key point for the Federal Reserve that comes out next week and has to decide what they guide the market to after the market's really repriced dramatically so far this year.
And who needs Fed speakers and economists on Wall Street when the president himself will tell you when the central bank's going to act, Bramo? AMH apparently is going to happen sometime soon.
Sometime soon. That, quote, little outfit is what the President of the United States was calling the Federal Reserve when he said on Friday night, he betcha those rates are going to be coming down. Jonathan, the timeline may be on the president's side. Interesting in the CPI report, I'm going to be looking at gasoline, which Bloomberg Intelligence says is creeping up. This could be something that could hurt this administration going to election, though, if we see gasoline come in higher than expected, even going into the summer peak driving season. But, you know, look at the FT poll over the weekend. People are feeling better about the economy. The issue politically is they're not giving Biden credit.
Well, what's Biden doing talking about the Fed? The Fed's going to cut rates anyway. This doesn't help them. This just makes it seem like it's political, even if it's not.
He wants to take credit for it? I don't know. I thought it was bizarre. Some people thought it was controversial. I didn't. I thought it was just a bit silly.
Well, I just don't understand what he's driving at. How does he get points and kudos for calling it a little outfit and saying you should do it when they're going to do it anyway, and they don't want to seem political?
Well, we have seen Biden really lean into the issues with the housing market and how people cannot get on the housing scale. What he's going to be talking about today when his budget comes out is something he talked about in the State of the Union, which is trying to give rebates for individuals to try to get on the property ladder, and cutting those interest rates feeds into that theme. This is very much to the Senator Elizabeth Warren camp of the Democratic Party.
The cutting rates, though, not a demand side story for me, supply side. It's unlocking the sellers, Bramo. That's what it's all about, because they've been locked up. Those people like you with 2-3% mortgage rates that won't sell their homes.
You're just like, looking over at me, trying to wind me up. You're the problem.
Don't you agree, though? It's a supply-side story.
Yeah, okay, you need to have a market before you can understand what the pricing is. And I understand that people like myself are not going to sell until they can buy something else with a mortgage rate that makes sense.
Well, President Biden wants to give people like you $10,000 tax credit just for selling their homes.
Sell your house, Bramo. It'll give you 10K. Do you want to sell your house?
And then John can buy it.
No.
Let's move on.
Didn't think so. Happy to move on. Equities right now on the S&P 500, negative 0.1% on the S&P. It's a small pullback. It's not a big deal. If you want some price action, can we throw up NVIDIA in the pre-market and just check it out briefly? Up by about 1.2% this morning. Lisa, Friday's session was just odd. Positive 5%, and then down at the close by negative 5.55% at the close on Friday.
It was $250 billion of market cap wiped out in 3 hours. What I find interesting is overnight, a Sunday night, you look at the gyrations in NVIDIA's stock, it's been something like $300 billion of market cap that you've seen just wiped out, brought back, wiped out, brought back. And it just sort of raises this question, okay, well, what's going on here? Does this indicate maybe some kind of topping out?
That has got to be the biggest one-day destruction of market cap on a single name with no catalyst, almost for no reason.
And that no one seems to care about at all, because ultimately they've gained so much. But you're right. We're talking big numbers. We're talking about a third of the S&P's performance so far this year tied up with NVIDIA's performance. So this really raises this question. It's the reason why I want to see Oracle earnings after the bell today. How much money are companies actually putting into investing in tech advancements at a time where this is supposed to be the future, but a lot of companies are talking for cost efficiency?
Good point. NVIDIA in the pre-market positive by 1.2%. Coming up this hour, Seema Shah of Principal Asset Management expecting volatility in equity markets. Henrietta Trays of Veda Partners as the president weighs in on a TikTok ban. And Krishna Mamani of Lafayette College on why the time to buy T-bills is now. We begin with our top story. Stocks edging lower to kick off a data-packed week. CPI, PPI, and retail sales all coming ahead of next week's Fed decision. Seema Shah of Principal Asset Management expecting rate cuts to start mid-year and writing this. Equities will likely see volatility ahead in the first half, followed by a renewed rally in the second. Once cyclical indicators bottom out and rate cuts finally begin, US small cap stocks should begin to narrow the valuation gap with large caps. Seema, I'm pleased to say, joins us now for more. Seema, good to see you. Welcome stateside.
Great to be here.
Let's get into that call. Too early to buy small caps still?
I think that we should be edging into it, right? I don't expect that you're going to see a straight line up by any means in the near future. As long as you've got the debate going on about rate cuts and the timing, growth, etc., then things will be difficult. But once you get closer and you can really see rate cuts in line of sight, and it's backed up by a still solid economy, slowing but solid, then that should really be the green light for small caps.
When you say edge in from what? What are you leaving behind? At the expense of large cap tech? At the expense of what?
So we're not trying to take away from large cap. Actually, we're just adding to the US at the moment. So taking away from a couple of other regions and adding to the US. Because I think it's a really brave person to say that at this point, yes, valuations are very, very expensive for large tech, but we're looking at tech over a long time horizon. And if there's going to be any pullbacks, any meaningful pullback, we're probably looking to add at some stage. We're definitely not going to be taking away. So this is trying to create a little bit more movement for the small cap space.
Taking away from a couple of regions. Are you talking about Europe?
Yes.
Okay, why?
Europe. Look, for Europe, the fundamentals are just very, very unattractive. Look, valuations continue to look attractive, but they always have. That's not a new story. It's to say, we write that in our report every year. Valuations are very attractive, but it's a value trap at this stage. So for fundamentals have to be in line with your valuations, and they don't look like they're very promising for this year. This is still a year for us in terms of US exceptionalism. There are other parts of the world which are attractive, Latin America, India, Japan to some extent, although maybe with some ambiguity being added to that. But Europe particularly is not the area that we want to be focused on.
I did want to ask you about some of the splintering that we see in the Mag 7 and what you take of that. But I have to ask about Jeff Yu's call over at BNY Mellon. Do you agree then that we could see parity on the euro and not the dollar, given the fact that there does seem to be this dissonance that hasn't been recognized by currency markets yet?
It's an interesting idea. And if I go all the way to parity, but I certainly do expect, look, I think that the ECB has to move either way, right? I think they're going to cut rates ideally sometime in line with the Fed. But if the Fed isn't moving, the ECB still has to go because they have a difficult economic story ahead of them. So then that does pull apart the euro and the dollar, pushing the euro down a bit further. But I wonder how aggressive the ECB can be. mean, they get going, but they would like to be more aggressive, and they can only be more aggressive if the Fed is also cutting.
You think the Fed decision informs the scale of ECB cuts this year?
Well, I think the currency is what's going to be informing, because we know that the ECB is typically very, very hawkish. I don't think it drives their decision-making, but I think it's something which does come into their consideration. They will never say that, of course, as we heard from Lagarde. But I do think that at the back of the mind, it is certainly playing.
It raises the question, how much influence does the FX channel actually have on inflation in the Eurozone? If we get the Jeff Yu of BNY Mellon, who joined us about an hour ago, who was talking about parity, Lisa mentioned that. If we get the parity move, how does that influence the inflation story in the Eurozone?
It will affect the inflation story, but it's also really going to help that export side of the economy. It's going to help the manufacturing side of the economy, which is really struggling. For a country like Germany, which has, I think, stagnation written all over it at this stage, I think it could do with any help it can get. So the currency, of course, it's concerning slightly on the inflation side a bit. It's one of the reasons why the ECB will probably go a little bit slower than they would like to, but I don't think that it's enough to scare them off from cutting rates.
You talk about American exceptionalism, and we've been trying to digest some of the moves in NVIDIA. We've been trying to digest some of the moves in Apple and Tesla, and this question around whether that's going to start to infect the rest of the complex. How do you stay confident in names that have rallied so dramatically and are now showing signs of exhaustion?
It is difficult, but look, we have to look at the earnings story. And again, we look at it over the longer term. What are the potential? We know that in the next couple of months, there is risk in those names. And you can see that bifurcation coming through in that Mag 7 anyway as well. But I think that when it comes to technology, we do look at that productivity story. We're looking at over a longer term horizon of what AI can do. And that's the position that we're taking. It is uncomfortable. It certainly will be uncomfortable over the couple of months. But again, you're taking the long game on this one.
How do you price in the China risk at a time where you have Gina Raimondo talking this morning about the U.S. doing whatever it takes to curb Chinese tech? We have a potential TikTok ban. You have a potential tit for tat escalating more dramatically. Has it been fully priced in, not just to tech, but also just to the multinationals?
I 100% agree. I don't think that is sufficiently priced. And actually, you know, over the last couple of years, every time we talk about large cap, the two things that are always a little bit concerning, or at least add hesitation, is regulation and China. And at the moment, those two are coinciding. So we don't think that's been fully priced in. It's something that we are watching very carefully. If we were to see some significant movement on that, which is really changing investor perspectives, then that's a case for maybe some reevaluation. But I don't think we're there yet. I think it impacts the earnings story, but not sufficiently that over the next 3 or 4 year horizon, it's going to take away as much as maybe it would convince us to reduce our exposure.
It begs the question, Tesla last week down by about 13%. China was part of this story. I know you can't do single names, but I just wanted the signal you take from some of these big cap tech stocks that have been hit by China concerns. What is the signal you take?
Well, okay, so there's specific names in there as well, which I think we do have concerns about, especially on the EV side. So we are trying to take a lot of that into consideration. I think on the EV side, we do have maybe more sustained concerns. Where the China angle comes in.
Can I ask you that?
No,
in Europe as well? Is it, how different is it in the continent? You're in London every day. How different is it over in Europe compared to, say, the US and China?
I actually think that the EV market in Europe, particularly in London, is extraordinarily strong. That drive there is, well, the demand for EV, just because of the way that the London congestion zone, etc., works, it's a very different story.
I won't ask you to explain the London congestion system, but certainly regionally it feels very, very different. The experience stateside is not what you see playing out in Europe or China.
You have better adoption in terms of just the consistency of some of the charging stations and the willingness of people to use cars. And we saw this with the rental car experiment, which to me showed everything. The fact that people shied away from electric vehicles because they just weren't used to using them.
That was the start of it this year. Hertz dumping like 20,000 EVs. Seema, good to see you to break down some of these issues. Thank you. Seema Shah is going to be sticking with us. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahira Hackers. Hey, Yahira.
Hi, John. President Biden is warning Israel that any invasion of the southern Gaza city of Rafah would cross a red line. In an interview with MSNBC, the president criticized the high death toll in Gaza.
The defense of Israel is still critical, so there's no red line, I'm going to cut off all weapons, but there's red lines that if he crosses, and you cannot have 30,000 more Palestinians dead.
President Biden had hoped for a breakthrough in talks before Ramadan, which began last night, but negotiations have stalled. Apple is preparing to open its 8th store in Shanghai this month. The move adds to its largest retail network outside the U.S. This despite slowing iPhone sales in China. It will be Apple's 47th location in the country. Commerce Secretary Gina Raimondo says the U.S. could further tighten controls on China's access to chip technology. Raimondo telling reporters, quote, "We cannot allow China to have access for their military advancement to our most sophisticated technology." Raimondo adding the U.S. will do whatever it takes to keep Chinese firms from accessing U.S. chip information. Her comments come as the Biden administration also weighs sanctions on several Chinese companies to curb the nation's development of semiconductors. And that's your Bloomberg Brief. John?
Yahara, thank you. Looking forward to catching up later this hour. Up next on the program, Washington, D.C. taking on TikTok.
We would lead to a path of potentially banning TikTok. Half of young people in America get a lot of their news all from TikTok. If you don't think the Chinese Communist Party can twist that algorithm, then I don't think you appreciate the nature of the threat.
That conversation coming up next, live from New York City this morning. Good morning.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a three.
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley.
Live from New York City, stocks lower by 0.1% on the S&P 500. In the bond market, yields basically unchanged. Where they were Friday at the close, 4.08%. Let's call it. In foreign exchange, the euro doing absolutely nothing. 109.40 on euro dollar. Other events this morning, Washington, D.C. taking on TikTok.
We would lead to a path of potentially banning TikTok. Half of young people in America get a lot of their news all from TikTok. If you don't think the Chinese Communist Party can twist that algorithm to make it the news that they see reflective of their views, then I don't think you appreciate the nature of the threat.
The reason why TikTok is so attractive, its value is it has an algorithm, a recommender engine, which is one of the best in the world. That is owned by ByteDance. As long as ByteDance engineers in China control the algorithm, they have to have access to American data.
Here's the latest this morning. The House set to vote this week on a bipartisan bill that could force TikTok's parent company ByteDance to divest from the app or face a ban in the U.S. President Biden throwing his support behind the bill, saying, quote, "If they pass it, I'll sign it." Henry Trace of Veda Partners joins us now for more. We won't get into whether the kids are communists already, because some might suggest they already are. I'm trying to work out if they pass it or not. They're going to pass it?
If they put this on the floor, it will pass. I mean, think of the optics of not voting in favor of this bill. This committee, where it's coming from, is extraordinarily bipartisan. It's gotten, glowing marks across the board since it launched. If it comes to the floor of the House, it will pass. And And then once it gets to the Senate, those two guys that you just had on, Mark Warner and Rubio, are the ones who are going to decide whether they want to tweak it or not. Now, they've gone through myriad iterations of this kind of a bill. So we've been working on this for years. ByteDance has known that this is coming. They have had public hearings. This is the kind of thing where they have given you fair warning. You should have been acting. So now we're in the realm of the purely political. My expectation is if it goes to the floor, it will pass. So the decision is leadership. And obviously, former President Trump has waded in exhaustively. And I think that the lobbying associated with that and Club for Growth is where the whole story is at this point.
And Kellyanne Conway as well is said to be working on behalf of TikTok in the sense calling lawmakers, telling them why they should not vote for this. With Trump weighing in, we've seen him weigh in on the border agreement, and that got pushed to the side. Does that happen with Speaker Johnson and TikTok?
It absolutely could. I mean, you've seen it with Ukraine aid, Israel aid, and the border bill. If Trump wants to derail this package in the House, he just needs to call Speaker Johnson, let him know that this bill should not come for a vote. And like I said, if it comes to the floor, it means that Trump's lobbying has not worked. Kellyanne Conway's lobbying has not worked. The Club for Growth and their $10 million allocation to the super PAC has not been sufficient, and they will bring it to the floor and it will pass. But political meddling at this point is what would keep it from passing. The bill is sound. The bill as it stands can pass the Constitution test. It does not explicitly ban TikTok. It goes after the nations of issue, China, Russia, et cetera.
When can we actually see a ban, though? Because to John's point earlier on the hypocrisy we're seeing in Washington, Biden's campaign is using this for outreach for 2024.
At a minimum, it wouldn't go into effect for 6 months. There are so many ways to delay this from actually being effective. So they have, studies that they can conduct, and then it's up to the president for his ultimate decision. I mean, this is the kind of thing that can take months to years before it has any ramifications. And just because it passes doesn't mean it's going to actually require ByteDance to divest. It's the beginning of the process.
Just to underscore this, what proportion of Congress members, not to mention the POTUS himself, currently use TikTok?
I mean, most of them, it's a huge campaign tool. You see them across the board. And of course, the president just waded in with his own TikTok campaign. And if you look at the letter that all those Republicans who are adamantly anti-President Biden and are working on behalf of President Trump or former President Trump have just written him a letter, I think it was, 2 weeks ago, a week ago, saying, how dare you? This is ridiculous that you would get on TikTok to try to boost your campaign when you're supposedly anti-TikTok. And now you're going to come out and say you support this bill. So the hypocrisy is all the way around, which is why you're basically in a political universe. So they're all trying to score points back and forth right now.
Politicians, hypocrites. Shocking. Absolutely shocking.
But the level here is pretty unbelievable.
I agree.
I mean, they're like saying, well, at least it won't go into effect for 6 months. So we could still advertise
Look
on
at how
TikTok.
it's lining up, though. We've got the national security risks of EVs. One, going to do something about that potentially. National security risk around ByteDance and TikTok. Two, potentially going to do something about that. Henry, for a long time, it was difficult for certain US companies to operate in China. There are certain tech companies that aren't there because they weren't allowed to be. So they're not too vulnerable. I'm thinking about everyone else. What is the tit for tat going to look like from China if we go in this direction?
That's the question, and it's not going to be just limited to this. As you pointed out, we're expecting USTR to announce a rotation of tariffs, potentially taking off some of the List 4A tariffs to put on the electric vehicles tariffs. It fits very neatly with their data privacy talking points around healthcare products, around monitoring where Americans are going, LiDAR, what our roads look like. It's across the board. So a Chinese retaliation is not just limited to, hey, we're not buying soybeans anymore. It's applicable to, different sanctions regimes, kicking out companies that are in the United States, that are in China, that are U.S. companies, exhaustive red tape. We saw this all during the 2017 and 18 escalation of the 301 tariffs. They tend to take it out on the U.S. corporations that are operating inside of China.
What's the daylight between Biden and Trump on China? Do you see any?
There's really not. I mean, if you meet with Ambassador Tai, she will happily tell you that the tariffs are higher under Biden than they were under Trump. There are no exclusions. You see China and the EU even not negotiating with the U.S. right now. And in part, you have to think, is it because a hypothetical President Trump would create loopholes or exclusions or licenses or one-on-one trade deals like we saw with Huawei or ZTE, wherein specific companies can get a carve-out when you have even these efforts that are seemingly broad in scope, and then you get all these licenses. I mean, go look at the USTR exclusions process. It was exhaustive during the Trump term, and those are limited.
I'm from the UK and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype or manufacturing possibilities with investment or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurise the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for the shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
I don't know what to call it. What are we calling it? Kickback fee to the government, the Treasury, $5 billion?
Yeah, and legal challenges.
It was a finder's fee, whatever it was. It was kind of odd, that whole situation with the Trump administration and TikTok. Do we understand the former president's position on TikTok? What was that 4 years ago?
4 years ago, the president's position is ban TikTok, be as anti-China as you can possibly be. And it was very well documented. You know, you don't have to search for it. It's there. And now that has materially shifted. And you have to pay attention to the former president's verbiage here when he says, you know, me and the Club for Growth are back in love again. That was the exact quote. It is to do with a $10 million donation back in June that saved Club for Growth via, you know, one mega donor. And that has continued, and now his position's totally shifted. We were all watching as Kellyanne Conway materially moved the needle with the president throughout his entire tenure in the White House. So to think that she's actively lobbying on behalf of this institution, going out to 10, I believe it was 10 specific members, that's all it takes to get the Freedom Caucus to sink the bill. Now, the bill is coming up under suspension of the rules. So if Democrats decide they want to pass it with Republicans, Kellyanne Conway has her work cut out for her, because it just takes 2/3 of the conference to pass the legislation. So I think it is a hard thing to do, which is why I say, you know, see if it even comes up. If it comes up, it will pass. If it doesn't, that's how you kill it.
Interesting. Just a major shift. Henrietta, good to see you.
Thanks for
the brilliant Henrietta Trays of Vader Partners, together with the also brilliant Seema Shah of Principal Asset Management. Coming up on this program, Herman Chan of Bloomberg Intelligence, 1 year on from the collapse of SVB. That conversation up next, live from New York. This is Bloomberg.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
Let themselves